Good morning, ladies and gentlemen, members of the Senate and friends. I'd like to welcome our colleagues and members of our virtual audience to the Senate Finance and Appropriations Committee's annual meeting. We're happy to be here yet again at the Science Museum of Virginia in Richmond. And I do appreciate your time, and I know we have already spent a significant amount of time together this year discussing the budget, COVID-19, and criminal justice reform. That being said, and with this being my first annual meeting as chair, I contemplated whether we should move forward with this meeting. I decided that the committee would keep this tradition but compress the meeting into one day. The tradition is important. Even in difficult times, we will not abandon it. This is because what we will learn here today is valuable not just to this committee, but to the entire Senate as we prepare for the 2021 session. This preparation is not just in regards to the fiscal outlook, but also to the other critical issues and budget pressures that we will face now and into the future. This committee has always taken the time to approach funding or policy issues in an intentional way, and that at times requires patience and multiple years to reach a solution. It is the Senate way to reflect on these issues and work together collegially to move the Commonwealth forward in a fiscally responsible manner. This year has been unique and unparalleled in that it has been difficult to plan and estimate what will happen. Dealing with the pandemic has been challenging, but we have risen to the occasion and produced an updated budget. In fact, the governor signed that budget yesterday. In March, I told you that the budget was focused on Virginia's future and prioritized the people of Virginia, and that is still true. The budget that we worked tirelessly to put together prioritizes the people of Virginia and continues to equalize that with structural balance. Prioritizing structural balance allows Virginia to maintain our triple-A bond rating. Structural balance is something that we will continue to keep our eyes on as we move forward in our deliberations regarding the budget in the upcoming 2021 session. During the special session, we were able to restore some initiatives that were unallotted and recommended for elimination by the governor. These restorations included investments in community-based behavioral health services, rate increases for waiver providers, a Medicaid adult dental benefit, limited overtime for personal care attendants, and investments related to criminal justice reform legislation. In the end, it is still a great budget for the people of Virginia, as I have reiterated several times. Today, we will explore whether there can be further restorations, if there will be additional increases in revenues for the budget we put together during the 2021 session, and what the other pressing needs and priorities are for serving the citizens of the Commonwealth. Since we will continue to strike the perfect balance between expenditures and revenues in 2021, this morning we have asked Dan White from Moody's Analytics to join us. Dan was with us several years ago in Williamsburg, and he is their Director of Government Consulting and Public Finance Research. He will offer some thoughts around the pandemic economy and the resulting vulnerability related to the national and Virginia economies. After a quick coffee break, we will have a presentation from our staff on Virginia's revenue and budget outlook. Charles Kennington will provide us with an updated summary of the forecast for revenues for the biennium, and April Keyes will focus on the outlook for the budget for the 2021 session. And because the Medicaid program is typically one of our largest budget drivers, this will be immediately followed by a presentation from Mike Tweedy on Medicaid enrollment, spending, and the implications related to COVID-19. After breaking for lunch, We will return to updates related to education and transportation. First, Tyler Williams will give us a review on how COVID-19 has impacted K-12 education. This will include a discussion on school reopening guidance, school divisions' fall instructional schedules, virtual instruction barriers, enrollment, and the outlook for the 2021 session. Next, in the area of higher education, we will observe that there are some issues that are similar to K-12 education with some key differences. The campus and dormitory closures this spring were unprecedented. Sarah Herzog will provide us with this higher education update with topics that will include virtual instruction, enrollment, and the known fiscal impacts related to tuition and auxiliary revenues. After another quick break, we will conclude the day with an overview and outlook on transportation. As you may remember, the 2020 session saw the passage of transformative legislation in this area. Jason Powell will weave us through these state and regional actions and then turn to the impacts that the current pandemic has had on the revenues and operations of the various modes of transportation. As you know, it's our tradition to embrace this meeting with interest and courtesy. Please use this meeting as an opportunity to learn, to have questions answered, and to begin planning for the critical budget and policy decisions facing Virginia. In this extraordinary and challenging time, I thank you for your participation today. And now I would like to ask Dan White to begin his presentation.
Well, thank you very much, Madam Chair. It's a pleasure to be before you guys today. I am going to share my screen, and hopefully you all are seeing some PowerPoint slides in front of you now. Awesome. Well, again, thank you for having me today. It's been, as the chairwoman said, it's been maybe a year or two since I had the chance to get down and see you guys. I wish I could be there, especially in someplace like Williamsburg this weekend, but alas, this will have to do. Really quickly, before I speak, if you've seen me speak before, you know that I always have to start my presentations with a quick disclaimer. Just to remind you all, so I work for Moody's Analytics, which is an entirely separate company from Moody's Investor Service, which is the ratings agency that I'm sure that you're all familiar with. We both report up through Moody's Corporation, but there is a clear separation between the two. So please don't let anything that I say today be misconstrued as having any bearing whatsoever on past, current, or future ratings actions. I apologize if that sounds like it was written by a lawyer. It's because it was, but like all good lawyers, it keeps me out of trouble. So I didn't come here to talk to you about ratings. What I did come here to talk to you about was the economic outlook, where we are, where we're probably going to go, and some of the contingencies around that path forward. What I was also asked to do by the staff was to make sure to give you guys a couple of important assumptions to really be keeping an eye on as you head into the spring months as you put this budget together. And also, I'm going to try and give you some practical advice and questions that you can be asking to make sure that you're holding the staff and the budget staff at the governor's office accountable as you put together this budget. Okay, so let's start off really quick with kind of the roadmap for where we are. So we've more or less exhausted every letter of the alphabet trying to describe what this business cycle should look like. I'm sure you've heard U-shaped recession, V-shaped recession. I've heard Nike swoosh recession. And the short answer is that this business cycle doesn't look like anything that we've ever seen before. It doesn't look like any of those letters. It started off, obviously, in the first and second quarters of this year with a very deep recession where we essentially unplugged about a third of the economy. And as a result, we saw about a third of the economy fall off a cliff. Now, the good thing about unplugging an economy versus having an economy run out of gas like we normally would in a recession is that when we plug the economy back in, a lot of that economic activity came back on. And it came back very quickly. It came back so quickly that I think it may have given some of us a false sense of security about what that looks like going forward, especially when we look at tax collections, we look at sales tax collections in particular in certain parts of the country. We saw a lot of a rebound in the second half of the year, second half of the summer. But now we're starting to see things really slow down quite a bit in certain places. Where we are now is really at the same time, the most boring and the most tense part of the business cycle, in that we are basically moving sideways for several months, waiting on two very important developments to occur to kind of get us into that next kind of post-vaccine recovery, when we would expect the pace of economic growth to proceed at the same pace that we would see in normal recessions, right? So the two things we're waiting on, and we'll talk about these assumptions in a lot of detail in just a second, are obviously some additional federal fiscal stimulus in the form of direct aid to small businesses, to individuals, and also to states and local governments. And then the second piece we're really waiting on is not only the development and the release of a vaccine, but a wide acceptance of a vaccine. And we'll talk about what that means in just a second, right? So we've still got quite a few months to go. You can see that there are parts of this business cycle that are going to look worse before they look better. That owes to the increase in infections that we're seeing right now. But we do get to the other side of this eventually. There is a light at the end of the tunnel, okay? Now, what this means on a regional basis, is not always the same across every state, okay? Not every state or not every commonwealth, in your case, is created the same. And we see that when we look at a lot of the economic data, especially the very granular very high intensity, we get, on a weekly basis data. What you're seeing before you now is a map of every metro area in the United States. And what these are differentiated by are basically what we call our COVID economic exposure score at Moody's. Now, this is basically an index where 0 is average, and red is more exposed and green is less exposed. But that average is built upon a variety of economic factors, again, that are very high frequency, things like the level of infections, commuting patterns. There's some like Google mobility data that's built into those, so we can see where people are going out, where they're eating, things like that. But there's also some structural factors involved in this as well. So commuting patterns, demographics, socioeconomic variables, high income, low income jobs, population density, and industry mix in particular are all included in this. And you can see based on this that the majority of Virginia is less exposed to the economic fallout from COVID than a lot of other parts of the country. So if you look at the New York City area, for example, parts of California, in the South, you look at Florida, some of the areas that really depend a great deal on tourism, for example, they have a tremendous amount of exposure and vulnerability to the economic fallout from this, right? Now, that has played out very well for Virginia so far relative to other parts of the country. So job losses have been less severe in Commonwealth Virginia. Information, construction, transportation have been the biggest differentiators along those lines. But really what's going on here is you have a very favorable industrial mix. You rely a lot on the government. You rely a lot on some very stable sources of economic growth. And on top of that, when we look at things like commuting patterns, Virginia actually in a large way kind of benefits from a lot of those commuter patterns in reverse, in that people are not having to go into the office. They're not having to go into DC to do a lot of their work. Those folks are staying home. They're working from home. They're spending their money more at home. And a lot of those people live in Virginia. And so that's actually having a positive impact on the state relative to other parts of the country. Now, when I say that Virginia is better most, that doesn't necessarily mean that things are good, that things are going well. It just means things are going less bad than other parts of the country, right? And what this means as well is that there is still a long way to go before we get back to any form of normalcy from an economic perspective. So you can see in the graph on the bottom left here, the potential recovery period ahead. You're going to hear me talk a lot today about two different scenarios, okay? The baseline scenario, which is the blue line you're seeing here, and then we have a severe scenario. We call it our S3. We actually produce 10 off-the-shelf scenarios every month for all states and metro areas, and we assign those letters and numbers. So this is our S3, our most likely severe scenario or downside scenario. The difference we'll talk about in a minute, but the differences are the assumptions around when and if we get any additional federal fiscal stimulus, and when and if a vaccine is rolled out and widely distributed and accepted. So under the baseline assumption, we don't get back to our previous level of employment in the Commonwealth of Virginia until mid to late 2023. Under the severe scenario that I'm going to talk about in just a minute, it probably is going to be until 2025, 2026 before we see that come out. Now, in the context of those two scenarios and in the context of the economic forecast itself, as you all are putting together a budget in the months ahead, there are two very important assumptions that I want you to be aware of and be watching on a very close basis, right? The first is the assumptions around federal fiscal stimulus. So the baseline forecast, which again is the blue line here in the top right graph, and it was also the blue line in the previous graph that I showed you. The baseline assumes that we do have additional federal fiscal stimulus to roll out in the first quarter of 2021, so calendar 2021. In terms of timing, you could assume that that probably happens sometime after the inauguration. What that looks like is probably what's baked into our model, at least, is about $1.5 trillion of additional federal fiscal stimulus. About a third of that going to local governments through the PPP program or some variation on the PPP program. About a third of that goes to individuals through either enhanced unemployment insurance or direct checks to stimulus checks to taxpayers. And then about a third of that, or maybe a little less, goes to states and local governments to help them offset the economic cost of the recession so far. This is going to be very, very important, especially that aid to states and local governments. The knock-on effects of not having that stimulus, so if we don't have those checks to taxpayers, the PPP money, the knock-on effects are that we have lower consumer spending well into fiscal 2022, which would really prevent any sizable recovery from kicking into place very quickly. So that's how we get a lot of that delayed recovery that we saw in the baseline versus the more severe scenario. Okay. Now, the second piece of assumptions here is around the rollout and distribution of a vaccine. Now, you'll notice that I talk about rollout and distribution. I also want to make sure we talk about acceptance. Because just because we're hearing news from Pfizer, the stock market's going up like crazy. Just because we have a vaccine does not necessarily mean that we can go back to normal overnight. We have to see the impact of the vaccine on the number of infections and the number of hospitalizations going forward. So even once that vaccine is released, if we expected it to be released and distributed to everybody who wanted it in the country tomorrow, it's still going to take some time for people to take that. And it's going to take some time for people to feel comfortable taking that. I mean, if you look at the uptake in terms of the number of people who take a flu shot every year, let that kind of color your thinking about how many people are going to rush out and take a COVID vaccine immediately. It might take several months before people feel comfortable enough that enough of the country has taken this to really make an impact on those total number of infections. So the numbers that the epidemiologists are giving us are that once about 25 million Americans have taken that vaccine, in addition to the people who have already been exposed to the vaccine, we should start to see things start to go back to normal. We'll be able to have fewer business restrictions. We'll be able to move on with whatever that post-vaccine world looks like. Now, the time frame for that obviously varies significantly depending on who you ask. But if we look at the projections that come from the Good Judgment Project and some of they're basically betting markets or odds markets around when this actually happens, it's probable that we don't see that happen until at least the fall, late summer, fall, before we see not only a vaccine released, but a vaccine that is produced and distributed to enough people in the United States where they can take it, and then enough people actually feel comfortable taking this kind of vaccine to go out and get it put in them. So it's going to take a while before we actually come back on this. Any delay in that timeline, so let's say the vaccine comes out next week or it's approved next week, and they say, we're not going to have enough doses for everybody to take it until June, then that's a major downside risk to this forecast. We assume that the vaccine is made available to people beginning in March or April, and that over the summer, by the time we get to fall, enough people have taken it to where we're making a major dent there. If for some reason we get approval next week and they say because of major improvements in our manufacturing process, we're able to roll these out in January, and we see a big uptick in people taking them in February and March, then this forecast might be more pessimistic or too pessimistic. It might be some major upside risk to the forecast. So these are the two most important things to keep an eye on when you're working on that budget. Okay. Now, trying to put together a budget in the middle of a pandemic is a lot like trying to nail Jell-O to a wall. I worked a long time trying to figure out a good kind of parable to describe this process as I work with other states. And somebody in a city that we work with very closely said, this is like trying to nail Jell-O to a wall. Every time we try and have the plan, every time we think we have something figured out, the vaccine changes and we get thrown off. And so what we have to do in nailing Jell-O to a wall in this particular instance is there are kind of three things that we really have to keep in mind when we do this. Now, if you go online, you'll find, and you Google how to nail Jell-O to a wall, in addition to all the great pictures like the one I just found, you're going to find a lot of advice. Apparently, there are a lot of people who have wasted a lot of their lives trying to figure out how you nail Jell-O to a wall in practice. And so if you're ever looking, for 15 minutes of YouTube videos to just kind of cheer you up on a bummer day, Google how to nail Jell-O to a wall. The one thing that you will find is a constant across all of these videos is the first piece of advice here, and it works well for budgets as well, is to use more than one nail. Okay. Now, by using more than one nail, I mean two things. So first is to come up with more than one plan to attack this and to deal with it, right? Now, we do that not by kind of guessing in the dark. We do that by using alternative scenarios to inform our planning process. And this has become a best practice in most states in the country and most local governments as well, not to rely just on one baseline economic forecast, but to rely on at least one, if not more, additional alternative scenarios that use different assumptions. So using the baseline forecast that I just talked about, in addition to the severe scenario, which assumes that we don't get any additional federal fiscal stimulus, and that infections rise so much over the wintertime that we actually see a delay in terms of when the vaccine comes online, right? So knowing what those different scenarios could be and planning around them is hugely important to getting through one of these types of crises from a budget perspective. The second thing that's important to do is to identify the key assumptions. So I just did that for you a little bit when we talked about the federal fiscal stimulus and the acceptance of a vaccine. Identifying those key assumptions and making sure that you understand how they play out in terms of changing the budget forecast is hugely important. So in a Commonwealth like Virginia, you guys are going to want to make sure to also focus on things like what the government impact looks like. What are the implications for higher education? I heard the chairwoman talk about that earlier. Making sure that you understand what those key assumptions are and how they play into your budget is huge going forward for this kind of a pandemic. And then third is to make sure and consider the whole picture. And we'll talk about this in just a moment. But when you're looking at the potential impacts of a pandemic or any type of recession on your state budget, making sure that you are looking both at the revenue side of the picture, but also the spending side of the picture, especially with Medicaid, other social benefit programs. Oftentimes those can be just as important to potential budget deficit as the revenue declines. Okay, so looking at the whole picture, looking at the budget holistically. Okay. Now, one of the ways that you can do that is through those alternative scenarios we talked about earlier. And we at Moody's have gotten quite a bit of publicity in the last 6 months by doing that kind of an exercise across all 50 states. And so April and Charles thought it would be helpful for you to see some of the stress testing exercises that we're doing on all states in the whole to kind of inform your budget decisions going forward. Okay, so first of all, how do we stress test a budget? The first thing we do is we go through and we have a revenue model for all 50 states. We tie that to underlying measures of economic growth, the same thing that Charles and the folks in your revenue estimating groups do. And we project what those look like both under a baseline scenario and under alternative scenarios like the severe scenario we talked about. The second thing that we do is we go through and we forecast the costs, especially the mandatory costs. We use Medicaid as a big proxy for that, as the chairman talked about earlier. Medicaid is the single largest piece of mandatory spending that we see at the state level. And it can be hugely impacted by changes in underlying economic conditions. You can see in the chart in the bottom left here, that is, so government social benefit payments About 85% of that category is Medicaid, and you can see the huge spike that we saw in early 2008 as a result of the Great Recession. We're starting to see that come online over the last several months for states now, and it's going to make a huge impact on budgets going at least for the next 2 or 3 fiscal years. Okay? Now, we run all those for all 50 states, and we get aggregate shortfalls for all 50 states, both on the revenue side and on the spending side. We use Medicaid as a spending kind of proxy for that. I won't go through this in too much detail because we're going to make sure to have questions afterwards. But the bottom line is across all 50 states, you have about a $275 billion shortfall under our baseline scenario. Under the S3 scenario, the more severe scenario, that grows to as much as $433 billion. So you can kind of see the 2 bookends of the distribution as you're associating, different assumptions around, do we get additional federal fiscal stimulus? If so, how much? When is that vaccine going to roll online? How bad are infections going to get over the wintertime? This is a really good kind of bookend to kind of think about what that distribution looks like. Just for context, under the severe recession, okay, this is going to result in the largest state budget decline or shortfall since the Great Depression. Okay, and I don't use that word lightly. We've actually gone through and looked at the data, and we cannot find a single instance in the last 80 plus years where state tax revenues have fallen by so much and mandatory spending has risen by so much as we see in this severe alternative scenario. What that also means is not only the magnitude grows, but the length of time grows. When we do these stress tests in normal years, if there ever will be a normal year again, what we normally see is the impacts of a recession kind of peter out after 1 or 2 fiscal years. You'd be hard pressed to go back in history and find any time where the impacts of a recession lasted in state budgets more than about 2 fiscal years. This one is going to last well beyond 3 fiscal years. And so even though things may be looking up and we might see that light at the end of the tunnel with federal fiscal stimulus and with a vaccine coming online, it's going to take several years for us to get back to our normal baseline in terms of the amount of revenues that we're collecting and the amount of Medicaid spending and other social benefits payments that we have. Okay. Now, the good news is that just as Virginia is outperforming in terms of the economic picture, we're also outperforming in terms of the size of the shortfall as a result of our budget and also the preparedness levels around that. So if you look at the cross-state changes, a lot of this plays into the same differences that I talked about earlier with the economic changes, right? So industry mix, commuter patterns, things like that. One thing that also plays a very important role in the size of the fiscal shock. So the map, for example, on the upper left-hand corner of your screen, that's the average shortfall, annual shortfall over the next 3 fiscal years as a share of 2019 revenue. So that is driven not only by the economic factors that we talked about earlier, but also by the tax factors. So what kind of a tax structure do you have in your state? For example, in North Dakota, which is bright red at the top of the state, they derive a tremendous amount of their economic activity and their tax revenue from energy, and energy prices have fallen precipitously as a result of this. Same things with Alaska or Oklahoma. You can see a state like New York, which does not rely virtually at all on mining or natural resources, but they have a tremendously progressive personal income tax in New York. And progressive personal income taxes are they add a tremendous amount of volatility into the tax code. So when we see a downturn, we see personal income taxes fall much more rapidly and then rise much more rapidly in a state that has a very progressive personal income tax versus maybe a flatter income tax like we do here in the Commonwealth of Pennsylvania. What we're also seeing as a result of this is preparation is huge. So the states who were prepared going into this are in much better position than states who were not prepared going into this. And the good thing is, given the size of the shock and the size of the shock after preparation, the average annual net shortfall for Virginia is around 3%, right? After we assume for revenues, shortfalls, Medicaid declines, and then we throw the reserves that Virginia has very dutifully built up over the years into that breach, we see a much more manageable level of shortfall over the next couple of years. The thing that is deceptive, though, is that's a manageable shortfall over a year or two, but over many years together, so 2 or 3, maybe even 4 fiscal years, if you tie that many in a row, it's going to make your guys' lives as appropriators very, very difficult in some of the decisions that you're going to have to make. Okay. Hopefully I didn't leave you on a bummer there, but that's the reality that you're facing as appropriators. And you have a heck of a challenge in front of you, and I don't need to tell you that. But the good news is there is light at the end of the tunnel. Those two assumptions we talked about, federal fiscal stimulus and the acceptance of a vaccine, there's a lot of upside risk around those. And the sooner that we can get to both of those points, hopefully the better the presentation, the more upbeat presentation I'll be able to give you the next time I get to come visit. With that, Madam Chair, I would be happy to entertain any questions that you or the other members of the committee have.
Are there questions for Dr. White?
I have a
Madam
question.
Chair, I do.
Madam Chair.
Senator Favola.
Thank you. Thank you, Dan, for the presentation. It was very informative. I'm just curious, do you have a sense of what size the federal stimulus package should be to sort of shorten our pain, our pain cycle, if you will? How much money specifically would really help Virginia in terms of coming to a point of stabilization?
Sure, Madam Chair, Senator, there are two pieces to keep in mind, right? The first is the size of the overall stimulus package and how that helps consumers, how that helps the economy. And then the second piece is obviously how it helps the state and the local governments in the state or in the Commonwealth. I'm trying to make sure I get Commonwealth right because I live in Pennsylvania and I know how very serious people take Commonwealth versus state. So I'm trying to keep up with that as best I can. So the size that's assumed in our forecast is about $1.5 trillion. About a third of that goes to consumers, about a third of that goes to small businesses, about a third of that goes to states and local governments. When we have done those stress testing exercises that I just walked you through at the state level, and we include local governments and we net out all of the money that states have in reserve and all of the money that the federal government has already given states, we think that that needs to be at least $200 to $250 billion going to states and local governments, but it could be as high as $500 billion. In terms of the stimulus, we think that $1.5 trillion is enough at this point to get us back on to a decent track until that vaccine can really kick in and be accepted. However, when you're at a time like we are now in the business cycle and things are tremendously uncertain, it always pays to overshoot that number as opposed to undershoot that number, especially given the political climate that we're going to have in Washington going forward. I don't know that we get another shot at this. And so making sure that we get everything in there that we need to get in there now, as opposed to let's just do a little bit now and come back to it later. I don't know that that's going to be the best thing. So the more, the better, within reason, obviously, but $1.5 trillion thereabouts should be adequate for where we are in the business cycle.
Madam Chairman.
Madam Chair. Madam Chair, John Edwards here. Madam Chair.
Senator
Madam Chair.
Sorrell.
Thank you, Madam Chairman.
Don, you're on mute.
Thank you, Madam Chairman. You recognizing me, Sorrell?
Yeah, I said Sorrell.
Thank you. Mr. White, it's good to see you again. And my question is, when you were here with us 2 years ago, you gave us a presentation. Obviously, it was very different pre-pandemic, but you presented a slide which showed us, I think, a 10-year time frame, and you pointed out that our economy had sort of been sustained on a series of sugar rushes or sugar highs based on various federal stimulus dollars that had been pumped in. You went all the way back to, I think, 2008, and then you showed us a slide that showed that the yield curve was about to invert, and you suggested that a recession might be coming as soon as that yield curve inverted because it had predicted so many recessions. And I think my recollection was that you thought that sort of the underlying economic fundamentals weren't that stable sort of going into this. And obviously this is a very different presentation because of the effects the pandemic is having on and government shutdowns and everything else. But I was just curious how much sort of the underlying fundamentals of our economy play into this, and also the yield curve in terms of business investment. Obviously everybody's focused on the pandemic and the stimulus, but are the underlying fundamentals of our economy still that messed up so that we're not really working from a good base, and and given where the yield curve is, or businesses just not spending or making investments or betting on those investments even with interest rates really low. I mean, it would seem to me if it's a great time to borrow and go out and start spending money on things like infrastructure or capital or equipment or things like that. I mean, do you have any thoughts about that relative to your last presentation?
Madam Chair, Senator, yeah, I think obviously we were dead right? We nailed it perfectly. No, I wish we could say that we had any of this right. When we last spoke to you, we did talk about the yield curve. We talked about when it inverted, and actually the yield curve was right again. We went into recession almost exactly 1 year after the yield curve inverted. Obviously, there are some very extenuating circumstances around that recession that came after that. And so it's going to be difficult to go back and prove that any of that had to do anything with the yield curve. But what we are seeing is that the yield curve has reverted. We are back to, back to normal in terms of interest rates, if normal is, as lowest interest rates that we've ever seen. We expect to see interest rates continue to remain incredibly low for the next 2 or 3 years. The real test getting out of this, so when we start to think about the post-pandemic economy, it's going to be growing the demand side of the economy. So we can maintain that demand as much as we can, with those sugar rushes, as you talked about, with federal fiscal stimulus. But longer term, what we have to do is we have to grow the labor force. We have to grow demand. We have to grow investment. And all of those things are going to take some very important policy decisions to be made coming out of that recession. The good thing about this is that we're seeing the labor market come back over the last 3 or 4 months, even without the enhanced UI and some of the sugar that we talked about before. So I think the labor market, there's a lot of people who want to invest, and there's a lot of built up potential in the labor market and in the economy. It's just getting to the other side of the vaccine and getting to a point where investors and businesses can start to feel secure or confident enough in the demand being there to really ramp up investment going forward. So I think we're in much better shape coming out of the vaccine than maybe we were 2-3 years ago. But it's going to take a while for us to really get back to where we want. And it's going to take some important policy decisions to get there.
Thank you.
Madam Chair, John Edwards here. I have a question.
Unfortunately,
Madam Chair.
those of you on remote, I can't see, but I understand Senator Edwards had a question.
Yes, I do. Mr. White, on page 9, you use the term general fund revenues are modeled using stochastic equations for each state. You use that term again under higher cost. Medicaid enrollment is modeled using stochastic equations. What are stochastic equations?
Well, stochastic is a big word that we like to throw around as economists because it makes us feel really smart.
It makes me feel dumb.
So stochastic basically means that we're doing a regression analysis. So we're taking, we're taking historical economic data and we're throwing it next to historical tax revenues, and we're looking at what that relationship is, and then we're projecting it out into the future. So given what we think, the unemployment rate is going to be, or disposable personal income is going to be, this is the tax revenue that we would assume would come with that based on how they've performed historically.
Okay, thank you. That explains it. Appreciate that.
Okay, Senator Evan, did you have a question?
I did not.
Oh, okay, sorry.
Thank you.
Is anyone here in the Science Museum have a question? Senator Marsden.
Thank you, Madam Chair. I've had recent meetings with folks in the construction industry, especially in the horizontal realm, road builders. And, you hear a lot of talk about infrastructure projects as a way of getting the economy back up and moving. And they're saying they're having a really difficult time finding labor, finding people willing to do construction work. What are you finding on the national scene with regards to if we did go down the stimulus path of infrastructure projects and spending, that we would be able to find the labor to do this?
Madam Chair, Senator, that's a great point. It's it's one of those kind of structural weaknesses that we talked about before the recession was coming. The fact that we don't have a lot of labor, and more importantly, it's some of that skilled labor. So it's not just people to go out and, hold a shovel. It's people to run the machines. It's people to do the engineering work. It's people to do some of the very skilled work that goes into this. And we don't have enough of it. And we didn't have it before the recession. We didn't have it. We probably won't have it after the recession. It's not just road builders, but it's also home builders. One of the reasons that home prices are going up so much is that we just, in the last 3 or 4 years, even though demand was there, we haven't been able to build houses quickly enough to meet that demand. That's a structural issue that's not going to be, alleviated by any, amount of fiscal stimulus. That's a structural thing that has to change in terms of the way that we're educating workers, but also in terms of the way that we're incentivizing workers to move forward. So it's a key consideration in any type of stimulus program around infrastructure, and certainly something that needs to be addressed on the flip side of the vaccine, regardless of what other kind of stimulus programs we want to have.
Are there further questions from people here at the Science Museum? Are there questions from anybody who's viewing us remotely? Well, I'm not hearing any. So thank you so much for your presentation. It certainly sets a somber tone for what we'll be doing the rest of the day and into the next few months. But it's good to have this analysis. So thank you so much.
It's my pleasure. Thank you for having me.
And we now will have a break until 10:30. This is confusing because I don't see who's saying what, you know?
It's easier when it's all Zoom.
It's either all Zoom or all not Zoom.
I was going to give you a quick visual on who you've got, too. And most people had their video off.
Okay, it's time to start up again. Next on our agenda, we'll be hearing about anticipated revenues, and we'll hear first from Charles Kennington and then from April Keyes.
Thank you, Madam Chair. I actually am going to just quickly start us off just to give us a quick recap, and I won't spend a lot of time on that since we've been together so many times and we've focused on this particular sequence of events this year. But if you turn to slide 4, we'll go into a 2020 session and 2020 special session, just a quick recap. Just a reminder that both the budget you did back in March and changed, it reconvened, and then in House Bill 5005, which I just got signed yesterday, the special session budget really reflected the Senate priorities, and these included a number of things. I won't spend a lot of time on this since, again, this is a review, but SOQ re-benchmarking, early childhood, some support for higher ed, a number of things in health and human resources, including full funding of the Medicaid forecast, some enhanced provider rates and waiver slots, and the expansion of permanent supportive housing. There was also some actions related to employee compensation, and then obviously full funding for the criminal justice reform legislation that passed, and some grant funding for body-worn cameras. And when you were here for the special session, you also took the action to allocate those coronavirus relief funds that hadn't already been allocated, and you did some language that was tweaked from what the governor had done in August on the housing evictions and utility disconnections. You also did prioritize structural balance, and you had a flexible deposit now in lieu of putting it in the rainy day fund to leave a cushion for some
Adam, I
potential
thought you were in
economic
charge. Let's roll this.
downturns and a larger than normal unappropriated balance. Moving on to slide 5, just a reminder, when the regular session ended, you went right into COVID-19 restrictions. That had some financial impacts as the lockdowns went into place, and that still continues to evolve. Again, a year of great uncertainty. The administration had anticipated that revenues would decline by approximately $1 billion per year. Okay.
Let me just remind those who are remote to please
So it cannot be
mute.
heard by online participants.
Please
Well, let's unmute and
remember
get it
to
rolling.
mute. We can hear your conversations.
Madam Chair, you are still muted.
We'll pause for a moment just to see if we can take care of that.
All right, now can you hear us, Senator Norman?
We can hear you.
Yes, ma'am, thank you.
Okay, good. Okay, April, start over.
Thank you. Just a quick recap. On slide 4, we went through the Senate budget priorities for both the special session and the regular session that ended back in March and reconvened in April. And those were just a number of things in education, health and human resources, employee compensation, public safety, and some things prioritizing structural balance. On slide 5, just a reminder that as the regular session ended, we went straight into COVID-19 restrictions, and you dealt with that when you came back in reconvened session. In April, in reconvened session, the administration had anticipated the revenues would decline by approximately $1 billion per year, so you began to take actions related to that and adopt those. Revenue collections for the fiscal year 2020 actually ended the year at about $234 million behind the forecast, and then July revenues were better than expected. I'm not going to spend a lot of time on this because Charles is going to cover that, but due to some timing, there are actually some payments in July that would have been due in June. And then Charles will cover the reforecast process as well. The governor's introduced budget for the special session 1 reduced general fund resources by more than $2.5 billion over the biennium. Slide 6 is a reminder about where the 2020 session budget ended. When you took some additional actions, it left $621 million in the unappropriated balance, assuming that there was going to be those further declines that I mentioned. Slide 7 is just a reminder of some of the appropriation actions that you took. including you did not do a planned voluntary revenue reserve deposit of over $600 million, and then there was another deposit later that you didn't do of $300 million. So all total, whether reserves or rainy day fund, you didn't do almost $900 million of those deposits that were planned. You also remember did some, when you were here for reconvened, you unallotted a number of, the majority of the new spending, which was over $2 billion. So moving on to slide 8, this is just a look at where for the special session as it was introduced budget, the changes to general fund resources. Again, I won't spend a lot of time there, but that's the negative $2.5 billion. On slide 9, this is a look at where the introduced budget, how it came in. The important point here is that the governor left an unappropriated balance of almost $500 million. And then when the Senate did its budget at the direction of the chair and the committee members, staff found savings to accommodate some restorations of a number of important items that had been in those unallotted categories. But the unappropriated balance was about $8 million or $8.8 million below that. Moving to slide 10, just a reminder of what the special session budget included from as the governor introduced it in August. There were some restorations of one-time initiatives, cultural initiatives, some funding for the historically black colleges and universities, and their attempt to plan what you were planning to do with criminal justice reform and policing initiatives. There were also some funding for some one-time funding for Housing Trust Fund, broadband, some additional funding for the Virginia Jobs Investment Program, an eviction and diversion pilot that was partially restored, some funding for land conservation, and a supplemental WQIF payment and dam rehabilitation. There's also some funding for absentee ballots, some non-general funds for a variety of food security actions, and then again, language amendments that I alluded to earlier related to eviction and utility disconnection moratoriums, election policy changes, and some other specific language in some other areas. Turning to slide 11, just a reminder of what the conferees agreed to and went as sort of guiding agreements. I mentioned that the unappropriated balances started to be about 490, closer to 500 million that the governor sent down. As the conferees were in their discussions, it was decided that the unappropriated balance should be no less than 300 million, that she should eliminate the contingent spending items. As you might remember, the Senate had a number of contingent items that had been planned to restore if revenues were good. So the agreement was to eliminate most of those and actually fund those programs. You also worked with the administration to address the allocation of the coronavirus relief funds and include some flexible language regarding the appropriation of the funds and some guidance if the federal government were to do some additional stimulus packages. The majority of the spending in the restored items had either been adopted in the 2020 regular session or addressed criminal justice reform. Moving to slide 12, just a high-level summary of the special session budget again that was signed yesterday. There was some additional net spending of about $240 million, again, mostly restorations of those unallotted items. And that left an unappropriated balance of $303.2 million. The savings and resources changes from what the governor did was about $280. And again, you allocated the coronavirus relief funds. There was that first-year flexible reserve deposit of almost $90 million, bringing your reserves to $1.2 billion by the end of the biennium. And an employee bonus that's contingent on additional revenue, which I'll mention in my second half of my presentation later, and then some language and technical amendments. The governor did executive amendments. Some 5 of the 10 were adopted on November 9th, and those resulted in spending of an additional $1 million and left an unappropriated balance of $302.2 million. Now, you'll see on here, because we went to print before he signed it yesterday, that he had until December 9th to take final action, but he has in fact done that. Slide 13, you'll just see across where things were. You'll see what the introduced budget was, the unappropriated balance, which with the technical is actually $490 million. And as you go across what was done, Senate, conference, and then in the final of that $302.2. The next slides, 14, 15, and 16, just a reminder so that you have it of what happened with the allocation of the federal coronavirus relief fund items. I will also note the governor has done, before he signed the budget bill, a few more actions. Sarah will mention a few of those in her presentation this afternoon. And then slide 17 is just a graphic representation of the reserve funds. And Madam Chair, I would turn it over to Charles if there are no questions on this first part of the presentation.
Are there questions on this first part? Senator Sasslaw.
The unappropriated balance, as we finished with House Bill 5005, is $300 million. Is that correct?
Yes, Senator Sasslaw,
Okay.
it is.
And when we left the reconvene session back in April, it was over $2 billion.
Well, I would say that wasn't what the unappropriated balance was. It's that you had unallotted those funds, and so then
Unallotted.
yes,
Well-
and then the governor then, when he sent down the budget in August for the special session, he actually removed the majority of those items so that they wouldn't go forward.
Are you using unallotted and unappropriated in the same term or different?
They're different. Unappropriated means that you haven't appropriated those items specifically for various items, whether it be higher ed, economic development. Unallotted means it's still there,
Right.
but you're not, there's a requirement to do a different action to spend it.
Of the $2 billion that we unallotted, how much of that is still unallotted?
Between 1.7 and 1.8 billion.
that's-
So you agreed to not move forward with those, and as I do the second half of my presentation after Charles covers the revenues, I'm going to talk about from his preview of what he thinks the resources will be, what I think would be possible or not possible.
Okay.
Madam Chair,
Senator Peterson.
Peterson, and April, let me just follow up on the same question that I believe Sasslaw had, but I'm asking it slightly differently. We have a reserve stabilization fund, revenue stabilization fund, which we typically call the rainy day fund. Then we have a revenue reserve fund, which is what we've been doing for the past 5 years or so, basically voluntarily holding money back. So we have effectively doubled what our rainy day fund is. And that looks like it's about $1 billion. Have we drawn on that yet?
Madam Chair, Senator Peterson, we have not. You might remember part of the reason you didn't do that, I think technically you could have, but part of the reason you didn't do that is because you removed that $600 million that I mentioned,
Right.
and then the additional $300 million. So you basically, you deferred doing about $900 million.
Follow-up question. So basically, by not putting that money in, effectively we removed it. Second
Yes.
question, and this is kind of what Senator Sasslaw asked, but when you say unappropriated funds, that's in addition to what's in our rainy day reserve fund.
Yes. Resources moving forward. And I'll talk more in the second half of my, Madam Chair, Senator Peterson, in the second half of my presentation about structural balance and the issues related to that. That was a big part of why you left over $300 million and why the governor had, when he sent the budget down, it was almost $500 million, is because the structural balance with the budget, there's a lot of one-time money, but not a lot of ongoing to cover some of those funding to cover some of this ongoing services.
And final question, Madam Chair.
Senator Peterson.
I assume when we talk about the transfers and all the money that have flowed through our budget and that we spent, and you've talked about one time, that includes, for example, the CARES Act money that we got from the federal government.
The CARES fund, I would put the CARES funding sort of, Madam Chair, Senator Peterson, CARES funding sort of on a side in a different area, because that is one-time funding, but that's federal funding that we originally wasn't even appropriated in the budget. So it's a big amount of funding that's one-time, but those aren't things that we use one-time general fund dollars to fund.
So that's not the numbers we're talking about right now. Okay. All right. Thank you.
Thank you.
Okay, Charles Kennington, your part is next.
Thank you, Madam Chair. Good morning. Can you hear me?
Yeah.
Great. As you know, Madam Chair, projecting general fund revenues amid the pandemic has been a challenge. Actions taken to combat the virus, and we can go to the next slide, please. Actions taken to combat the virus and slow the rate of infection have resulted in a loss of revenues to the Commonwealth. Those losses are reflected both in the actual FY20 collections and in anticipated revenue reductions that were assumed in the budget just adopted during the special session. However, as I hope to illustrate over the next dozen or so slides, with actual collections coming in better than expected and other encouraging signs, staff anticipate the need to make some upward adjustments to the revenue forecast for FY21 and 22. And next slide, please. First, just a reminder of the past several months. Before the first case of coronavirus was confirmed, year-to-date revenue collections were tracking up about 8% over the prior year and well ahead of the forecast. In fact, you might remember that because revenues were above plan, that a mid-session forecast added $292 million in additional general fund resources to the budget that was adopted during the 2020 regular session. But by the end of March, the situation had changed pretty dramatically. President Trump had declared COVID-19 a national emergency. Governor Northam had issued a statewide stay-at-home order and non-essential businesses were closed. Nationwide initial unemployment claims had risen to over 3 million, the highest on record by far, and stock markets had suffered one of the most dramatic crashes in history. By the end of FY 2020, on June 30, we ended the year with a general fund revenue shortfall of $234.2 million, or $232 million when you include transfers. Next slide. The 2020 general fund revenue shortfall met the criteria established in code that requires the governor prepare a re-estimate of general fund revenues. So in July and August, the governor convened meetings of the Joint Advisory Board of Economists and the Governor's Advisory Council on Revenue Estimates, and the resulting interim economic outlook incorporated significantly slower growth than what was assumed in Chapter 1289. And the revised forecast released in August and incorporated into the current budget reduced total general fund revenue collections for FY21 and 22 by a total of by 2.7 billion, or just a bit more than that, 2.8 when you include the reduction in transfers. Next slide. When the Joint Advisory Board of Economists met in June, the standard forecast called for a significant contraction in the economy in FY21. GDP was projected to contract 4% for the year after what was thought to have been more than 2% decline in FY20. By comparison, the October 2019 standard forecast assumed GDP growth of 2.1% in FY21. Likewise, employment was expected to fall in Virginia by 2%. You could contrast that with the expectations in the previous fall when employment was expected to grow 0.6%. So these and other similar assumptions form the basis of the minus $2.7 billion revisions to the forecast that was incorporated in House Bill 5005 that the General Assembly passed during the special session. Next slide. Now, however, we're more than 4 months into FY21 and actual revenue collections are better than expected. General fund revenues are 6.7% above the same period in FY20, or about $555 million above the annual forecast rate. Now, about $250 million of that, we are told, reflect payments received in July that typically would have been remitted in June of the prior fiscal year, and that's related to the delay in the deadline for filing federal income tax returns. Many taxpayers waited to file and pay their taxes after the end of the fiscal year. Even when excluding the $250 million of current year collections attributable to the previous fiscal year, the growth rate is just under 3%. Revenue collections from sales tax, corporate income, and recordation taxes are all running significantly above original projections and are driving much of the positive revenue results. Next slide. Not only are revenue collections coming in better than expected, but the overall economic outlook has improved somewhat. As part of the regular fall reforecasting process, the Joint Advisory Board of Economists met on November 4th, with the majority of members endorsing a standard forecast that reflects better economic conditions than what was anticipated when the board met just 3 months earlier. For example, rather than a 4% contraction in GDP in FY21, the standard forecast calls for a 0.8% increase. And similarly, Virginia employment was expected to fall just 0.3% for the fiscal year instead of a 2% decline. Next slide. So, Madam Chair, with that as the backdrop, the staff has, as we do every year, developed our best estimate as to how revenue collections will perform over the biennium. Accounting for money in the bank and the improving outlook, staff think it's reasonable to add back about $1.5 billion of the $2.7 billion that was subtracted from the two-year forecast in August. And that would assume actually zero growth for the remainder of the fiscal year and about 2.7% growth in FY22, with most of that growth coming from income and sales tax. It might be appropriate just to mention at this point before we go any further, when Dan gave his presentation, he talked about the need to have multiple scenarios. And I'll just explain that the next step in the forecasting process, Madam Chair, of course, would be the meeting of the Governor's Advisory Council on Revenue Estimates. And you will recall that when the administration presents its proposed forecast, it will present to you both a standard forecast and a pessimistic forecast, and then some discussion will happen around that. Our estimate would be akin to the standard forecast, just to put that into context. However, I'll just say this year, much more than any year, our outlook contains a lot of uncertainty. Much depends on the efficacy of any vaccines that are made available, the willingness of people to get vaccinated, and the public's comfort level going back to pre-pandemic activities. And in the short run, a lot depends on infection rates and the public policy response. Next slide. So this is how our estimate breaks down by year. The largest differences between our forecast and the revenues assumed in House Bill 5005 are in sales tax, net individual income tax, and recordation tax. In sales tax, we expect a gain of 1.5% for the year. That is down from the FY20 growth rate, but well above the forecasted decline of 9.7% that's assumed in the current budget. That translates to an additional $835 million over the 2 years. We anticipate growth of 1.8% in net individual income taxes for the current year, compared to 0.8% growth in 20 and a 0.6% growth in the official forecast. And that translates to about $228 million in additional revenue over the biennium. It's not broken out on the slide, but we also anticipate a gain of about $250 million over the 2 years in the category of wills, suits, and deeds, which is mostly recordation taxes, and I'll have a little more to say about that shortly. So our view is that in total, it would be appropriate to increase the general fund forecast by approximately $862 million in FY21 and $657 million in FY22. The next few slides will provide a little more detail and some insight into our thinking in developing our estimates of the individual sources. Next slide. First, let me say that we expect after what was an unprecedented drop in economic activity and a partial rebound, the economy will continue on a gradual recovery. Real GDP shrank 31.4% on an annualized basis in the April to June quarter, which was easily the sharpest quarterly decline on record. The following quarter, GDP rose 33% on an annualized basis, according to what's the first advanced estimate from the Commerce Department. Our view is that following this initial bounce, growth is expected to moderate because of a few reasons. One is there's some, what you might consider catch-up spending that pushed some of the some spending ahead of trend. We see fiscal support tapering off. And of course, I would just expect that businesses and consumers continue to be very cautious as infection rates increase. Next slide. During the recovery, we're seeing that higher wage jobs, those in professional and business services and technology companies and the like, have been less vulnerable to job losses, and that's supported withholding tax collections. Staff believe that while overall unemployment in Virginia will likely be modestly lower in the current fiscal year, job growth in these high wage categories will translate to higher total wages and higher withholding collections over both years of the biennium. And just to give you an example, the average wage in professional and business services is over $90,000 a year, and that's expected to grow more than 2% in FY21 and more than 3% in 22. On the other hand, leisure and hospitality jobs, one of the sectors that have suffered the most under the pandemic, wages pay on average about $22,000 a year, and those jobs are expected to continue to decline over the current fiscal year. Next slide. Consumers have also proved remarkably resilient. That and growth in e-commerce sales support continued growth in sales use tax collections. In September, U.S. consumer spending was just about 2% below February levels and down just 0.6% versus the prior year. Just a couple of days ago, the Commerce Department released the October retail sales report, and October retail sales are up 5.7% from the same month a year prior and are now higher than the February pre-COVID high water mark. So sales and use tax collections are up 7.8% year to date. We don't expect that to continue. In fact, we have allowed in our forecast or in our revenue estimate that sales tax collections could decline modestly on the order of about 1% over the remainder of the year and still be up by 1.5% in the current year. Next slide. We are also expecting that internet sales will continue to support growth in sales and use tax collections. It's not surprising that consumers are shifting spending from bricks and mortar stores to online, but you might be surprised just how much they're spending online. In the last quarter of FY20, nationally, e-commerce sales increased more than 44% compared to the same quarter the year prior. E-commerce penetration is now more than 16% of retail sales, or just under $1 in every $6 spent. The Wayfair legislation that the General Assembly passed in 2019 became law in FY20, and that has been a real boon to sales and use tax collections. The Secretary of Finance has made this point on a couple of occasions. Just to give you an example, in FY20, more than 90% of the year-over-year growth in sales and use tax collections was directly tied to new Wayfair-related dealers. Next slide. So lastly, I just want to mention recordation taxes. We expect that the forecast for recordation tax revenues will be adjusted upward. As you know, mortgage rates are now the lowest they've been in modern American history. The average 30-year mortgage rate has fallen steadily since early in the year, down below 3% for the first time since officials have been reporting this data since the early 70s. The Mortgage Bankers Association forecasts refinance activity to be as high as $1.75 trillion in 2020. That's a nationwide total, and that would be the highest level since 2003. They forecast that activity to fall pretty dramatically in calendar year 21. So we believe that since revenues from wills, suits, and deeds, which is mostly recordation taxes, are now up 37% this fiscal year versus a forecasted decline of 12.6%, our forecast would add back about $250 million to the official forecast for the biennium. And just like the Mortgage Bankers Association's forecast, we would expect that revenues in this area would crest this year with a sizable decline in FY22. Next slide. And Madam Chair, that concludes the presentation on the revenue outlook. What I intend to do next is spend some time talking about the income tax provisions in the CARES Act and some decisions that the General Assembly will be faced with in terms of conforming with federal tax law. But I'm happy to stop now and take questions if you'd like.
Yes, are there any questions for Charles?
Madam Chair, this is Senator Bell. I have a question, and I'm not sure if it's for Charles or perhaps for you, and I apologize if it would have been better in the last section. My question is, have we received any feedback from Moody's or any other rating agencies on the amount of money we do have in the rainy day fund as far as revenue? I would suspect there's probably some revisions going on from the rating agencies, and I appreciate any feedback you can give us on that. Thank you.
April.
Madam Chair, Senator Bell, the Secretary of Finance and the administration typically is in touch periodically with the rating agencies, and we have not gotten any negative feedback. But again, at this point, that was part of the reason why there was no recommendation to take additional money from the rainy day fund of reserves, especially since we deferred putting in almost that $900 million that I referenced earlier. Thank you.
Madam Chair, just a quick comment on that.
Sure, Senator Bell.
Yeah, I would only say I appreciate that answer. I recommend we kind of have a take note on that to follow up, because I think protecting our rating is critical, and any feedback the Secretary can give us on that as we get to where we're close to finalizing the budget, especially given where we're at with COVID at the moment. I think that's going to be critical, and protecting that rating, I think, is got to be a top priority for us. Thank you, ma'am.
Thank you. I agree with you. Any further questions?
Madam Chair.
Senator Marsden.
Thank you, Madam Chair. Clearly our national debt and deficit is exploding. April, what do we receive yearly in terms of transfers from the federal government for, aid to all the different things that we do? Do we have a total on that amount?
Madam Chair, Senator Marsden, I do not have that with me, but I would be happy to follow up with you to give you that larger number.
Okay, thank you. Because at some point in time, I think, as the federal government has to cope with the deficits and debt, at some point in time that could affect those transfers and could impact our, ability to get things done. And I was just, kind of curious as to whether we kind of plan for those scenarios where we have, reductions in federal aid and how we deal with that. But if you can handle that offline, that'd be fine. Thank you.
Thank you. Senator Sasslaw.
With respect to FY 2022, as I look at the numbers that you all put up in your projections, how far are we below or maybe above the projections made during the 2020 session, last January, February, and March, for 2022? Are we down $700 million? We up? Are we over it by what? Because I keep seeing a different set of numbers.
Madam Chair, Senator Sasslaw, with respect to 22, I'd have to just do some checking, but we are in our outlook just about $1.2 billion below the two-year total in revenues that would have been in the budget adopted in the 2020 the 2020 regular session.
But, Madam Chairman, you keep showing that our revenue collections are running better than what we projected. Now, is that based on what we projected last March or what we projected a few weeks ago?
They're better than what was included in the budget adopted during this special session. They would be, and I don't have the exact number on offhand, but I believe the number would be slightly below the FY21 number that would have been included in the budget adopted during the 2020 regular session.
All right.
Madam Chair. Yes,
Senator Barker.
Yes, just following up on that, clearly, I mean, we've been, I think, somewhat cautious in terms of 22 because it's a little hard with all the issues related to the pandemic to know exactly what's going to play out. But if the virus news, which has been very good the last 2 weeks, I mean, the vaccine news has been very positive the last 2 weeks, and there was a discussion just this morning about a rollout of one of the vaccines that would basically have pretty much everybody who wants to be vaccinated being able to get that done by April, May, and June of this fiscal year. If that does pan out that way, is it not correct that there would be the opportunity or the potential expectation that we would have a further upward adjustment in the projection for fiscal 22 once we see that happening?
Madam Chair and Senator Barker, the answer to that is absolutely yes. We, in our thinking, followed sort of the same logic that Dan outlined, which is that a vaccine would become available at some point in mid-2021 and then would become widely accepted and to the point where the majority of the population is inoculated at sometime in mid-22. So there's really a lot of upside potential if the timeline for vaccinations, moves up ahead of that forecast. Now, as far as, adjusting the revenues for FY22, you would have a couple of opportunities to do that. That could be done both during the upcoming regular session. The governor could send down a revised forecast the following fall, and then you would still have an opportunity in the next General Assembly session to, again, to adjust those revenues if revenues are coming in better than expected.
Madam Chair, I think I have a question for staff, and like a lot of people here, I'm a visual learner. If there was a way that we could have a table which shows the original projections that we made and passed back in March, and then the amended projections that we passed in the House Bill 5005, and then in between where the actual numbers are going. Because I agree with Senator Sasslaw, it's very confusing as to are we up, are we down, and we just need to know where these baselines are. So if you could have that type of table, I think we would, I don't know if I would use the word intelligently, but at least be able to discuss this with a little bit more comprehension.
Madam Chair, I have a question. Madam Chair, John Edwards here. I have a question.
Senator Edwards.
Yeah, on page 33, you talk about the CARES Act as a number of provisions that impact.
Senator Edwards, we're not there yet.
Where are we?
We just finished page 31.
Okay, all right.
Madam Chair?
Senator Barker.
I would agree with what Senator Peterson spelled out there in terms of sort of how we can look at things. Because the answer to the question is, are we up or are we down? And the answer is yes. We're both. So we are still down from what we had projected back in March when we put together the budget that we passed then, but we are well ahead of both the revised forecast that was used and built into the budget that we dealt with during the special session, and we also are well ahead of what we were through the first 4 months of last fiscal year, even if you take out the $250 million that was sort of a delayed delayed set of payments there. We are still well ahead of that, of the actual experience. And that was ahead of 4 months that last year was well before the pandemic was even thought about. So it's not as if it was related to that. And I think it also would be helpful for the members of the Senate to understand how much revenue we lost in April and May based upon where we had been going up through February and March of last year, because those 2 months really did a number on the revenues that we brought in fiscal 20, but we still did much better than what I think most people had anticipated we would be at once the pandemic hit with full force in April and May.
Madam Chair, Senator Barker, Senator Peterson, I'm happy to prepare some materials to that effect, and we'll get that to you as soon as possible. Madam Chair, if there's no more questions, I will continue with the presentation.
Yes, please do.
Thank you, Madam Chair. We can go to, yes, thank you. The CARES Act that was signed into law back in March contains a number of provisions that will impact individuals and businesses related to income taxes. And during the 2021 session, the General Assembly will have to make some decisions with regard to conformity to federal tax law, as these provisions could have a significant revenue impact. There are four provisions that would directly impact four business provisions that would directly impact Virginia taxpayers. Three of these essentially reverse parts of the Tax Cuts and Jobs Act and have a significant revenue impact if Virginia elects to fully conform. The fourth business provision is a provision excluding Paycheck Protection loan forgiveness from taxation. It would have an unknown but likely small negative revenue impact. There are also four provisions that would impact Virginia individual income taxpayers. Now, earlier this summer, the Department of Taxation prepared preliminary estimates regarding the impact of conforming to these provisions. These estimates are based on what was the most recent revenue forecast at the time, so be aware that these estimates could change as the revenue forecast and underlying economic conditions change. At any rate, over the next several slides, I intend to discuss the revenue impacts of these and explain a little bit more in detail about what these provisions are. I suspect there will be quite a bit of discussion around these as we get into the regular session, so consider this sort of a preview, if you will. Next slide, please. This slide shows the estimated revenue impacts in the current biennium if the General Assembly chooses to fully conform to the tax provisions in the CARES Act. The first three business provisions, I'll explain more in a few minutes, but these would have the largest revenue impacts, and it's primarily due to the fact that these provisions modify changes that were previously adopted in the Tax Cuts and Jobs Act and are also retroactive to prior taxable years. In total, the business provisions would reduce revenues by $665.7 million in FY22, and conforming to the individual provisions would reduce revenues by an estimated $34.2 million in 21 and $7.5 million in 22. Next slide. So the first provision that I want to talk a little bit more about is a provision that allows non-corporate taxpayers to deduct what's called excess business losses arising in tax year 18, 19, and 20. Under the Tax Cuts and Jobs Act for taxable years 18 through 25, these excess business losses of a taxpayer other than a corporation are not allowed for the taxable year. The CARES Act reverses that for 18, 19, and 20. Full conformity is expected or estimated to reduce revenues by $305 million in FY22. Next slide. The CARES Act also increases the limitation on the deductibility of business interest from 30% of adjusted taxable income to 50% for tax years 19 and 20. You'll recall that the TCJA, or the Tax Cuts and Jobs Act, previously limited the business interest deduction to 30% of adjusted taxable income. In response to the limitation that was imposed by the TCJA, you'll remember that the General Assembly enacted a Virginia-specific deduction during the 2019 session that was equal to 20% of the amount of interest deduction that was newly disallowed under the TCJA. Okay. Preliminary estimate is that this would result in a loss of $47 million in FY22, with much smaller impacts in the years that follow. Next slide. The TCJA also previously limited the net operating loss deduction to 80% of taxable income effective for tax year 18 and after. It also generally eliminated the carryback for net operating losses generated in tax year 18 and after. But the CARES Act would reverse that provision of the TCJA by allowing taxpayers to fully offset their taxable income by net operating losses, and also allowing an enhanced 5-year carryback period for net operating losses generated in tax year 18, 19, and 20. So these changes are retroactive and could apply back or could result in amended returns as far back as tax year 13 for net operating losses generated during tax year 18. The preliminary estimate is for a loss of more than $312 million in FY22. Next slide. There are also 4 individual provisions that would impact Virginia taxpayers. The first is the COVID-19 related retirement distributions. This would allow taxpayers to include COVID-19 related distributions in taxable income over a 3-year period. Normally, you're only allowed to do that in the same taxable year. Taxpayers may also avoid taxation on COVID-19 related distributions to the extent that the funds are recontributed to the retirement plan within 3 years. There's an exclusion for certain student loan repayments by employers, so employees are permitted under current law to exclude up to $5,250 per year of employer payments made under an educational assistance program. The CARES Act would make certain student loan repayments eligible as well. The CARES Act would also allow individuals to claim the standard deduction to claim a new above-the-line deduction of up to $300 for charitable contributions made in cash during 2020. And there's also, the CARES Act would provide enhanced charitable contribution deductions for individuals and corporations, which essentially increases the income-based limitations. Next slide. And Madam Chair, like I said, this is sort of a preview of the issues that the General Assembly is going to be faced with next in the regular session. As always, when it comes to tax conformity, there's a variety of things that the General Assembly might choose to do, including conforming completely with these provisions, deconforming completely from these provisions. You may choose to conform only for tax year 20, in a sense deconform from the retroactive provisions. We've done that in the past when it comes to things like enhanced net operating loss carrybacks. Or you might deconform from just certain provisions. For example, one might consider with respect to the business interest deduction, you could conform to the federal increased deduction but eliminate the Virginia-specific provision that was created back in 2019. Madam Chair, that is the presentation on conformity, and happy to take questions.
Are there questions on conformity?
Madam Chair,
Senator Peterson.
I think the elephant in the room is PPP and whether or not those loans are going to be forgivable. I will tell you as a small business owner, and I know that I'm not the only one in this room, there are a lot of us that have been holding that money aside, wondering how the federal government is going to treat that money, whether or not it'll be forgivable or whether or not it'll be taxable. And I don't know what the right answer is, but I just think that that's going to be a huge variable as we come into at the end of this calendar year and into next year. That's not a question, but it's a comment.
And I see Charles is nodding in agreement with you. Is there any further question?
Madam Chair. Quick question.
I hear somebody, but I can't see who it is.
Me, Senator Favola.
Oh, Senator Favola.
Okay, thank you. So my question is, and I guess it's sort of a broad brush thing, on the CARES Act, are the federal provisions applicable to all businesses of any size, and regardless of what their sort of revenue picture had been during the COVID crisis?
Madam Chair, Senator Favola, I'm not sure I have the answer to that. I mean, if there's a specific situation that a taxpayer
Well, I think, Madam Chair, there might be some value in looking at the different sectors of our business economy to determine how we would move forward, whether we would abide by conform to all federal requirements, conform to some, or to take a different approach.
Madam Chair, John Edwards here.
I was going to call on Senator Newman next, and then I'll do you, John.
Sure.
Thank you, Madam Chair. Well, I agree so much with Senator Peterson. There are so many companies that are holding on to that money, and I know for Charles, it's hard to really understand when that money will hit the P&L and what impact that'll have. My question is a little different, Charles, and that is, has staff been able to at least begin to look at what would happen if we had a new Congress that undid the Trump tax cuts? I remember when we spent that money and when we gave the personal deductions and that type of thing, but we put in that provision, I believe, a unwind portion that would go into effect if that was undone. Is that something that you've started to look at, or are you going to have to wait a while to see the impact that that would have either on 2021 late or on 2022?
Madam Chair, Senator Newman, that is not something we've looked at. We have spent a little bit of time, looking at the proposals that Vice President Biden has put forward, but we haven't done any analysis yet. Be happy to spend some time on that.
Thank you, Madam Chair.
Senator Edwards.
Yeah, the question I have, it kind of follows up on all of these questions. This is a very complicated situation to conform completely, deconform in different categories. I'd like to see staff, if they could, at some point, give us a breakdown. If you deconform in this category, what does it mean? If you deconform in that category, what does it mean? And who's affected by it? I mean, I think it's very complicated, to say the least.
Madam Chair, Senator Edwards, we're happy to work on that for you. Thank you.
Thanks.
And I'm assuming the Secretary of Finance will also be working on it.
Sure.
Okay, are there further questions for this section? Not hearing any. April, you're up again.
Thank you, Madam Chair. Moving on to page 41, we'll start to talk about the budget pressures and the 2021 session outlook. Just a reminder, on December 16th, the governor will present the introduced budget for the 2021 session to the General Assembly at the Joint Money Committee meeting. So that's coming up sooner than you think. If you turn to slide 42, the agency requests were almost, this time as the governor's preparing to do this next budget, were almost $3 billion for the biennium. The agencies were directed to limit those requests to state and federal mandates, emergency needs, and other unavoidable changes in services or costs. As you can see, they're quite substantial in a number of areas. What I will say is this doesn't include, for the most part, across-the-board salary increases or even statewide requests related to the coming minimum wage increase. So there's some additional pressure there. It also doesn't include the Medicaid forecast, which we'll talk a little bit more about in the coming slides. Turning to slide 43. Staff did an analysis of those requests. What are the major budget pressures or commitments? There's a number of things on here. You'll see the Department of Health has a big number to support vaccination and disease surveillance in the coming biennium. There's you might recall there was a contingent employee bonus that's supposed to go into effect. It would take about $98 million. That's there. In your budget that you adopted during the special session, there was language that directed the governor to include funding in the budget for the 2021 session for SOQ salary actions if additional revenues were available. So this is a placeholder, a 1% compensation supplement for instructional support positions of about $48 million. There's some updated SOQ costs if you were to go back and put in the school counselor positions, some additional things related in education to learning management system, special ed staffing, and school quality. Some higher ed, this is just the priority one recommendation. Sarah is going to give you a further breakdown later today on some of the other priorities. Increases in inmate health care for state police, some additional funding related to record systems, earned sentence credits, and unavoidable vehicle costs. And the next amount is for the replacement of their system under ELECT. There's some additional funding that I won't spend a lot of time in, but I will note that on these next couple of lines that there is, at least to pay the interest on the unemployment trust fund and some other mandatory things that have already been decided related to grants and MEI projects. And there is some savings under debt service, and then there's another category. But you can see it's almost $192 million even in the current fiscal year, and almost $590 million in the second fiscal year. Turning to slide 44, I'm going to briefly discuss the Medicaid forecast, but I would ask you to hold those questions for Mike, who will do the next presentation in detail on Medicaid. But the Medicaid forecast reflects net savings currently due to the higher federal match rate, which we've discussed a number of times. For the 2020 session, there's a projected net savings of almost $188 million over the biennium. Again, from the extended match rate for an additional quarter, there's some more savings. An additional almost $40 million is expected by paying monthly managed care payment rates early to capture that higher match rate. The spending for Medicaid would have been projected to increase about $607 million over the biennium, and that's reflective of a higher enrollment due to that requirement, federal requirement to continue coverage for the enhanced match rate, and then an additional $465 million in enhanced payments to hospitals. You might recall state matches paid from assessment on hospitals. But the forecast essentially anticipates overall Medicaid spending to grow at 18.2% in 21 compared to the forecast last year of 7.2% and 7.5% in fiscal year 2022 compared to the projected 5.9% last year. Turning to slide 45, this is sort of the high-level look at the 2020 session comparing resources to spending needs. Available resources from the forecast are sufficient to cover major budget pressures. However, other items that typically would be considered, you won't have a lot of funding for that. The structural balance in the second fiscal year is a concern. And again, there's significant risk related to the uncertainty with the ongoing pandemic. As Dan White said, is trying to, nail Jell-O to a wall. We're going to have to keep revisiting where we are. And so when you think about those unappropriated balances, that leaves you some cushion in addition to reserves. But as you see the bottom line, the forecast that Charles did is sort of in the middle line in the table with the additional 1.5 billion there in resources, minus those major budget pressures or commitments that I just covered. You'll see there's funding in year one, but by year two, you're down to about $72 million there just from the must-do or high priority items that staff identified. You do have some additional funding, as I mentioned, that the unappropriated balance was about $300 million in the first year. So you've got a number of one-time funding, and I'll talk about that in just a second. But this doesn't include the numbers that Charles discussed related to federal conformity, which are quite large. So to the degree that you choose to do any of those things, that takes your resources down as well. Moving to slide 46, just some additional thoughts about funding commitments and priorities. Additional funding related to COVID-19 impacts may be needed to address state government operations, as well as things in both K-12 and higher education, and I'm sure other things. Agency requests, again, were not consistent in addressing costs related to those planned minimum wage increase. For instance, we'll also see some increase in costs and capital related to projects that are not under construction yet. If you want to revisit items that were unallotted, you can do so, but as you can see, we've got a structural balance issue in that second year, and it will be a little more difficult. Additional salary actions will likely be a budget pressure, again, for state and local employees, and I mentioned the teachers. Other requests related to business and individual relief will be likely unless there's an additional federal stimulus package or two. Decisions around tax conformity are going to be difficult just because of the large costs, and there might be, as we assume, legislation to further look at criminal justice reform and other issues as well. Turning to slide 47, overall, again, you have general fund resources of $1.5 billion above what was available in the recent special session from the staff predictions. Structural balance, again, needs to be a key and be a concern as you start looking at what you would like to do for the next biennium. I mentioned the Medicaid forecast, but Mike is going to go into that in more detail. Operating budget requests of $3 billion for the biennium, and again, budget, the major must-do or high priority are at $700 million alone. Keep in mind your economic uncertainty for a second wave or surge of the virus and access to that vaccine. So again, that's a significant risk to your revenue growth and just an unknown. You may want to consider, as you think about that structural balance, some one-time funding, additional funding perhaps for reserves, cash for capital outlay, that's something we've done in the past, or providing additional resources to the Unemployment Trust Fund. New funding requests will need to be weighed against ongoing or existing commitments and any plans for increasing revenues from other sources. And Madam Chair, that concludes my portion of the presentation.
Thank you. Are there questions? Not hearing any. We will go on to the next part, which is our Medicaid section. And Mike Tweedy.
Thank you, Madam Chair. So for the remainder of this, this should be after tab 3 in your binders. So for the remainder of this morning, I'm just going to quickly provide a high-level overview, basically all things Medicaid. So moving to slide 2, the outline. So more specifically in this presentation, I would discuss trends in Medicaid enrollment and spending, the 2020 Medicaid forecast, the impact of COVID-19 on Medicaid, trends in other states, as well as provide a brief update on Medicaid expansion and discuss healthcare spending and its cost implications for Medicaid. So moving to slide 3. So starting off, I will provide an overview of the trends in enrollment and spending for the program. So if you look on slide 4, Medicaid enrollment is growing. It should be no surprise after the expansion of Medicaid began January of 2019, as well as the effects of the pandemic that are occurring right now. The reason Medicaid enrollment is so important is because it is the primary driver of spending in the program. Typically, it reflects at least half of the spending growth in the program over time. So this chart shows that prior to Medicaid expansion, the program was averaging about 3.9% each year since 2010. That is still faster than population growth. And since expansion began in FY 2019, it has averaged about 12% a year. And the FY 21 number is just a year-to-date number. So it is also affected by the pandemic as well. So the requirement that we not basically disenroll people from Medicaid during the pandemic is accelerating enrollment. And so that's reflected as well. So typically, and the reason why that really matters is because typically in Medicaid, you have thousands of individuals who enroll every month and thousands who disenroll. So the federal requirement that doesn't really let us disenroll basically means that on a monthly basis, you have thousands of additional individuals who are qualifying for Medicaid. And just to kind of give you an example, since March, when the pandemic began, base Medicaid, the enrollment numbers, and and if you hear me say base Medicaid, I mean the traditional program, the non-expansion part of Medicaid, and there's the expansion part, that there's 69,000 above the forecast for non-expansion and about 64,000 above the forecast for the expansion population. So those are really more directly related to the pandemic and the federal requirement. Moving to slide 5. So along with enrollment, of course, Medicaid spending is also increasing. You can see prior to expansion, it was averaging about 5.3% growth per year. And of course, naturally, it is higher with expansion, with the implementation of it. You can see in 2019 and 2020, it was averaging about 16%. This chart shows you the total spending, kind of broken out by the federal and state share. Typically, the share is roughly 50% state and federal, 50% federal when you look out over time. The Medicaid expansion, which has a 90% federal share, changes that. So you can see in that fiscal year 20, which was the first full year that Medicaid expansion was in effect, federal funds reached about $8.5 billion. So 64% of program funding was from federal funds. The state funds, you can actually see, if you see that drop a little, that's because, as you may recall, that with expansion, there are certain populations that were covered under base Medicaid that actually qualify for expansion. So there was a slight reduction there in savings on the state fund side. Moving to slide 6. On this slide, this just gives you the annual growth rates for both enrollment and for spending. So you can see that typically enrollment, they kind of shadow each other. You'll see a few instances like in 2012 where they actually kind of deviate. And unfortunately, that's actually due to delayed payments from one fiscal year to another on the spending side, which sometimes happens in order to make sure that the budget is balanced for Medicaid by year end. But typically, enrollment would track it because it is such a primary driver of spending. As expected, the growth rates, of course, do rise rapidly, with expansion taking effect in 2019. And in FY20, you see the added effect of the federal requirement to maintain coverage during the pandemic to receive the enhanced federal funds. I did note just the 2 bullets on this side, the lower ones, that base Medicaid growth rates. They're kind of masked because, as I said, certain populations moved over from base Medicaid to expansion. So you can actually see that the base Medicaid population declined in FY19 and 20 by 2.9 and 3.9%, but has increased by 6.9% in FY21. And that is primarily due to the federal requirement to continue coverage for individuals. Moving to slide 7. So after talking about enrollment, that's the primary driver. Another driver within Virginia's Medicaid budget are managed care rates. And this is just due to the fact that about almost 70% of total Medicaid spending in Virginia is now through managed care. And of course, any changes in those rates can result in significant funding shifts. And this is, federal law requires states to that these rates be established and be actuarially sound. So we actually have an actuary who helps develop them. And so it's not something where the state could just decide one year that we don't have enough money, so we're just going to keep the rates at zero. We're not going to grow them. That option doesn't really exist to states. There are other things that they have to do, policy options that they would have to consider in order to change this. But just to give you a quick example, in the special session budget we just passed, there were $129 million in general fund Medicaid savings because the final rates for fiscal year 21 were below what we had estimated in the previous forecast. So that additional savings actually helped in the decision-making to let some of the other items in Medicaid kind of go forward in the special session budget. So, and just as an example at the bottom I gave you, you can see for the managed care programs, FY22 is the only remaining assumption of this forecast. You can see CCC Plus, and that's the long-term care managed care program because we have 2 in Virginia. You can see that assumption did increase by about 1% in this forecast. So, when they have wide swings of several percentage points, you can imagine 70% of the program, it can make a significant difference in the budget.
Madam Chair.
If you don't mind, Senator Peterson, let's wait till he finishes his presentation.
The next slide, on slide 8, the 2020 Medicaid forecast. So April already briefly mentioned this. As you know, the forecast is developed every year by the Department of Medical Assistance Services, and it's submitted to the General Assembly by November 1st. Budget language this past year did modify the process to involve the legislative staff more in its development to help provide some feedback. So that work did occur, and I think is moving toward improving the process to try to make sure that we have the best and most accurate numbers. On slide 9, you see this table just kind of gives you, the fiscal year 21 is in red, and then fiscal year 22. I won't go over the details. It just breaks it up by the major fund sources and the shifts. But you can see that the forecast does project a general fund savings of $188 million. So there's about $206 million in savings the first year, and then the second year, there's actually an additional general fund need of about almost $18 million. So when you net those, that comes to the $188 million. You may see numbers quoted on the official Medicaid forecast a number that's actually $245 million in savings. That's because there's about $40 million that they had actually DMS incorporated in the forecast that really is a policy decision. It's the acceleration of a monthly managed care capitation payment to take advantage of the expiration of the enhanced federal match. This is something that, you know, we had actually done under the previous federal funding in the Great Recession. But however, that's still a policy decision that needs to be made and should not have actually been reflected in the forecast. But if you see that number, that's where the difference comes in. Now, even though there's state savings, the total forecast does increase by about a little over $600 million. But mainly most of that comes from the federal funding share and from the provider assessment. So just a reminder, you can see in here the two assessments. There are two separate provider assessments that the state charges hospitals. One is the coverage assessment. So when I refer to that, that is the actual assessment being paid to cover the 10% share of the cost of Medicaid expansion. And then the rate assessment is the other piece that pays for enhanced Medicaid rates across the entire Medicaid program. So basically, the hospitals put up the state share to pay enhanced Medicaid rates. The rates are actually increased basically to what Medicare would have paid, since Medicare is a higher payer than Medicaid. Moving to slide 10. So like I said, the Medicaid forecast is higher than 2019, but because of the shift in the federal funds, it does mask that a little bit. But you can see that spending growth is estimated at around 18% in 21, then drops to about 7.5% in fiscal year 22. And you can see that primarily the FY21 growth is due to that enrollment growth, which coincides with both. You still have some growth from the expansion side, but a lot of it has to do with the federal requirement that we continue coverage for everyone that was in Medicaid. As is usual in Medicaid, there are pluses and minuses. So there are other embedded savings that you really can't see. Managed care pharmacy rebates, which reduce pharmacy expenditures, are actually up quite a bit. Fee-for-service costs, and fee-for-service costs is the spending outside of managed care. So this is the more traditional way. For example, dental services for children are paid on a fee-for-service basis. DMAS just pays the dentist for the care. Those services have been down, just like with pretty much any payer. Those costs actually were dropped as people avoided going to the doctor or the dentist in the earlier part of the pandemic. So there are some saving items, but there are also increases too. One of the big increases I'll note is that the actual rate assessment payments, these are kind of a moving target. So this is where the hospitals are paying the state share. So that's why it has no general fund impact. But it does result in a significant increase in non-general fund appropriation by about $435 million. And I will just note too, one other assumption that was embedded within the managed care rates for FY22 is an assumption related to the COVID-19 vaccine, about $21 million. It is generally expected that the federal government will make the vaccine probably free in most cases, maybe even to Medicaid. And so really the cost that you would have left, which could be smaller than this, is really just the cost to administer the vaccine. Moving to slide 11. So like I said, the enhanced federal match for Medicaid is really what drives the general fund savings. So this was part of the Federal Families First Coronavirus Relief Act that was passed back in March. It's basically tied to the public health emergency until the quarter in which the public health emergency ends, and this is the public health emergency as declared by the Secretary of Health and Human Services at the federal level. In the quarter that ends, that's when the enhanced match would end. Right now, that's going to be the first quarter of calendar year 21, which is the third quarter of our state fiscal year. And that additional savings is about $170 million, which was included in the Medicaid forecast. So that's a major part of how you get to the other savings. And I just noted here the other amounts that we've already, over $650 million in federal funds that the Commonwealth has already received in 2020 for that purpose. On slide 12, this is a slide that I've used before. This basically just shows you in each biennium, there are basically three forecasts of Medicaid that take effect. There is the amended forecast, which is what the current 2020 forecast does, is it's the amended forecast. And then there's kind of the caboose, which is the last one that comes in to kind of adjust the second year appropriation to correct for whatever trends are going on. The initial budget forecast you can see in blue, the blue bars, is always the largest because it has to fund the basic growth in the program over the biennium. The amended forecast is typically a more modest adjustment. You may recall 2 years ago it was very significant for other factors, but in most biennial budgets it's pretty modest. This year's amended forecast, of course, is the savings due to the enhanced federal matching funds. And the last time that there was a savings was back in the 2014 and 16 biennium. On the next slide, 13. So kind of along with all the other uncertainty that the pandemic has created, there are still unknowns with Medicaid, just like there are with revenues and other things. Most of the enrollment growth so far has really been due to that federal requirement to maintain eligibility during the pandemic. Typically Medicaid, which is a counter-cyclical program, so that you would see more people show up when economic times are tough, you would see that stemming from unemployment. According to the DMAS so far, they really haven't seen that piece. That pretty much these are the main reason for enrollment growth is due to the federal requirement to maintain enrollment. So that remains an unknown going into FY22. If you continue to have an extended period of unemployment or other disruptions, that you could start to see individuals qualify that way. There also remains uncertainty as to when the enhanced federal match will end. Like for every quarter, it's kind of a moving target. If that keeps added, it does provide additional funding to the state, but it also requires us to continue to cover the additional enrollees that can't be disenrolled. And so while I know the focus today is on the 2021 session, it's always important to keep in mind that next year's Medicaid forecast will cover a new biennial budget. So in addition to just normal program growth, there are other costs that will need to be addressed. So for example, personal care rates, those would likely have to be adjusted to kind of reflect the changing and the increase in the minimum wage over time. And there's also many other provisions as well. But just to kind of, as an example, if Medicaid were to grow by about 6% a year in next year's forecast, that would actually require about almost $1.1 billion in general fund dollars to fund that. So just, a heads up about next year as well.
Before you go to the next session, let's, Senator Peterson, you had a question?
Yes, Madam Chair, a question about, we've talked about managed care rates, and I believe you represented, Mike, that 69% of the population is now being served through managed care. Is that correct?
It's 69% of the expenditures. It's most of the population's in it. There are just some things that we do outside of managed care, but about 70% of the spending, yes.
And obviously, the whole point of managed care is we contract with the managed care providers and pay them, and then they individually contract with providers underneath them, correct?
Correct.
Do we keep track of how much money actually that we spend through managed care actually flows down into the providers that are actually serving people vis-a-vis just going to the corporate bottom line? These are all for-profit companies, of course.
Yes, we do. It's an improving process. That is one of the things that once we kind of pay them, and we kind of lost some of that data about who gets paid. But just like with anytime you go to the doctor, there's an encounter. There's, they call them encounters. That's all tracked. We are collecting that data from the managed care companies, and over time trying to making better and better use of it. I know that DMAS also uses through the Bureau of Insurance. So as managed care companies, they have to report their financial data quarterly to the Bureau of Insurance, and so they track that to see how well they're doing. We do, based upon what JLARC did a few years ago, we have profit loss caps for the insurers, as well as medical loss ratios, which basically say that they have to limit their administrative expenses to some degree. So, and we will likely see, based upon this past year with such lower utilization that they've experienced, just like every insurance company, it's very likely that, and it's a rare thing, that they will actually have to, at the end of the year, pay the state back some of that money. So there are things that have been put in place to try to make sure that they don't just get to keep all that money and profit off of it.
Thank you.
Are there further questions on this section?
Question, Madam Chair.
Senator Favola.
Mike, you mentioned, and this is accurate, that the enhanced match for the federal Families First coronavirus relief will actually continue through the first 3 quarters of fiscal year 2021. So my question is, with that enhanced match, did you, were those dollars calculated into your expected 1.1 billion in general fund growth, if you will? What I'm trying to say is, will the coronavirus relief dollars help offset some of the expected growth in Medicaid during the next 3 quarters in fiscal year 2021?
Madam Chair, Senator Favola. Well, I guess there may be 2 components to that. So with regards to, the only thing the forecast takes into effect so far is that the public health emergency ends in January. So the enhanced match currently is set to go through March 31st of next year. Yes, it does seem that by January 21st, the emergency will be extended. So it's not reflected here because the forecast really has to reflect what we know for sure. So yes, what will likely happen is potentially in the session or maybe in the governor's introduced budget, they may reflect an additional quarter depending on when they announce that extension. And yes, it's entirely possible that it can even go another quarter. The 1.1 billion I referenced is actually for fiscal years 23 and 24. So that's a whole next year issue. So depending on how all this works itself out, if additional federal funds come, yes, that will play a role in mitigating impacts in fiscal year 21 and 22.
Thank you, Madam Chair.
Further questions? Okay, let's go on to the next section.
So on slide 14, so I'll just briefly highlight other states and kind of how they're faring through Medicaid. So if you look on slide 15, recent surveys show that pretty much all 50 states are experiencing higher growth in Medicaid caseloads and spending. You can see the enrollment increases are projected for fiscal year 21 to be about 8.4% higher and 8.2% in spending. And this is actually after many states actually saw basically flat or slow enrollment growth back in fiscal year 20. But so far, if there is good news, the good news here is that the enhanced federal match does provide the sufficient federal funds to cover the additional cost of the enrollment. However, of course, every quarter that it's extended is a larger and larger population that you continue to carry in the Medicaid roll. So there could become a point where the federal funds are not sufficient to cover it, but as of right now, it still does. And one other positive for Virginia, especially compared to other states, is really that from a budget perspective, that about half the growth in the population has been Medicaid expansion. So Virginia, unlike a lot of other states, expanded Medicaid with the provider assessment on hospitals because it isn't something that the state really did before. So we actually had that option where other states have heavily used provider assessments to fund Medicaid for many, many years. So that does actually shelter the general fund from some growth in population on the expansion side. Although, of course, you have to note that the hospitals do pay that increasing burden. But at least on the expansion side, the state share is only 10%, and the feds pay 90%. So on the next slide, 16, so this is, I won't go into great detail. This is just, the slide is just showing you over time, and I talk about this almost every year, but it's relevant, but it occurs in all states that Medicaid spending relative to state budgets is so critical because it's just consumed a larger and larger share over time. And the only way that states really can address that is they can either increase revenue, they can find ways to reduce Medicaid spending, or they have to reduce other discretionary spending, such as higher ed. And you can see that in some states, even Virginia, where that's had to give over time to some degree. But just to show you some other states, kind of, some of them have had to take actions this year to contain their Medicaid spending. So Nevada actually adopted a 6% cut in provider rates across all their providers. Colorado did 1%. Other states are still looking at reducing benefits or changing cost sharing. Virginia has not yet had to take such actions, and even in the special session, we're able to allow some of the provider rate increases that were needed to go forward and other important changes to the program as well. Moving to slide 17, I just also very briefly talk about the impact of COVID-19 on Medicaid. So in slide 18, so yes, it has, certainly the pandemic has had a significant impact on Medicaid. I already talked about the enrollment and of course the federal requirement to maintain coverage. But Medicaid has seen, just like other healthcare plans, the reduction in people not using services. We receive that most directly from the fee-for-service side, which is a small part of our program now. But for example, dental services for children, like I already mentioned, is one of those services. And there were several months where those costs were down by about 70%, and kind of at the height of the closures. So while that has returned up to some level, it is not expected to really fully return to normal for some months. We already, I just had already talked a little bit about managed care. So one of the things to note about managed care is while we don't immediately see a direct savings from that lower utilization, it's because we pay them a monthly rate. That monthly rate is to be paid over the year, and it doesn't change until the next year. However, as I kind of already went over with the question by Senator Peterson, is that we do actually have measures in place that if they make too much money, that they actually do have to return it to the state. So we actually may see something in the governor's budget where they might actually estimate, some of that payment back to the state. Like I said, I won't go into great detail, but there have been many other changes in Medicaid to help individuals during the pandemic, such as allowing for 90-day prescriptions, eliminating cost sharing, and waiving service authorizations. There's also the nursing home $20 a day to provide some financial support to them, and many other things that they've done as well. And while many of these do have some cost impact, they're really intended for during the pandemic, so that it's pretty much a one-time cost. So moving on to just kind of a quick update on Medicaid expansion, slide 19. And I won't go into great detail here, but if you look on slide 20, so Medicaid expansion, it did lag the enrollment at the beginning. It finally actually crossed over basically this past January, where it actually began to exceed it a little bit. And that's mainly due to the fact that it was the first open enrollment period for the federal exchange that we've had. And one of the uncertainties in the estimates for Medicaid expansion was how many people would shift from the federal exchange to Medicaid. So back when it began, it was a smaller shift than expected, and what we saw was a larger shift here. But what you can see here is in the months after January, it actually returned to kind of the growth rate it was already on. But then what happens is in April, you actually see a much faster growth rate, and again, that's because of the federal requirement to maintain coverage, and we can't disenroll individuals during the pandemic. And so right now, at the current growth rate, by the end of the year, expansion will likely pass about 500,000 individuals. However, this number, once the emergency is over and people can be disenrolled, it's likely to actually, it will likely drop to some level where it will stabilize. The next slide, 21, I won't go into great detail. This just gives you the cost of expansion broken out by the state share and the federal share. The feds pay most of it. You can see FY21 does increase by about 22%. In 22 and 23, it's growing by about 15% a year, but there's a lot of uncertainty with that growth because we don't know when enrollment may actually level off or it may even decline, and that would certainly impact those amounts. But you can, so that just kind of gives you that feedback. On slide 22, I kind of close this on Medicaid expansion. The question that I often get is kind of like, how much does this benefit hospitals since they pay the provider assessment? And I already talked about there are two assessments, the coverage assessment and the payment rate assessment. I wish I had a simple answer to this question. It's not. Not that there are that many simple answers in Medicaid, but this slide kind of gives you kind of from an industry perspective overall, but it does have quite a few caveats. So first off, actually let me talk about the payment rate assessment because that one actually is simpler. So the payment rate assessment, the hospitals are really just paying for the state share of larger Medicaid payments. So intuitively, of course, they receive, there's a financial benefit to them to do that. Now, you do have to remember that only 2/3 of the hospitals actually pay the assessment. There are many exceptions. Small rural hospitals, critical access hospital, the children's hospital, they're kind of exempt from the assessment. So some hospitals will receive a greater benefit than others from that. But in that scenario, definitely all the hospitals receive it. And you can see they paid $343 million in fiscal year 20. I'll use that as an example. And it was just over $1 billion in additional revenue that came back to the hospitals from that. So trying to estimate the impact from the coverage side. So basically by having a larger portion of the population covered with insurance going to the hospital. So you can see for the coverage assessment in 20, they paid about $259 million. And if you assume that about a third of all medical spending would flow back to the hospitals, that would be about $921 million. But again, remember, not all hospitals pay it. And also, as I mentioned before, some of the populations had moved from base Medicaid to expansion Medicaid. So, so some of these costs are actually not new revenue. It's just shifting from somewhere else. For individuals who moved from the federal exchange where they had commercial insurance into Medicaid expansion, again, the hospitals already had that revenue. So it's not easy to decipher exactly their direct benefit. It's not easy to also account for if there's increased demand for those hospital services. The hospitals, of course, also have higher costs. So the best thing I can say is that this is something that I'll continue to work on and look at. I'll definitely continue to talk with the Hospital Association. They look at this analysis too. I think to really understand it, you actually have to look at it at a hospital by hospital basis to see, because it's going to vary greatly between hospitals as to what financial impact it occurred. So with that, I'll just kind of move on to on slide 23, talk a little bit about just in general healthcare cost, and moving to slide 24. So I'm not going to go into great detail this slide because it's in front of you. This just shows you over the decades, basically, how economic growth reflected through gross domestic product has averaged each decade per year versus health spending. You all know that health spending has typically outpaced it. Although the better news is that at least in especially the current decade, the gap between the two has closed. To a large degree, it's due to the Great Recession in the earlier part, but we still haven't seen a dramatic return to those higher growth rates. So that's at least a positive, but it's still faster than economic growth. But as you all know, and you've heard many times, the U.S. spends basically about twice as much on healthcare than other developed nations that are similar to the U.S. Essentially, just to note here, about $10,637 per capita in 2018 versus about $5,500 in some of these other developed nations that are similar to the U.S. And a large part of that difference is in hospital and physician costs. You can see $6,624 per capita versus $2,718 in these other nations. So there's definitely a big difference there. And in slide 25, this slide actually shows you the same thing in the bar chart. It's just showing you broken out by health spending, by physicians, hospitals, and prescription drugs, which is kind of the third major piece of this. And you can see how that's slowed over time, but it's still in the current decade grows about 4 to 5% per year. But it makes perfect sense that doctors and hospitals are the largest share. They make up more than half of all health spending. That is the main components of the healthcare system. But that's also the reason why I think that states, when you think about how this flows through, that these cost increases, they do eventually flow back to Medicaid. And this is why that strategies do have to be looked at from both a hospital and a physician perspective as well. So flipping to slide 26. So this gets me to the point, if you look at this passed in the 2020 session, the General Assembly did approve 2 strategies in Medicaid. One is the Emergency Room Utilization Program, and the other is the Hospital Readmissions Policy. You may have heard from your community hospital that they don't like these because, of course, it can reduce their revenue. But just very briefly about what they do is the ER utilization program, what it does is it will reduce the payment to the hospital or the ER doctor if it's a non-emergency use of the emergency room. Yes, they don't necessarily always have complete control over who comes in their door, but I think the goal of this initiative is to try to encourage those providers to help develop additional diversion strategies and to also improve care coordination with the managed care companies for which Medicaid covers these individuals, to try to figure out ways to divert these individuals to, especially if they can, to a primary care home. So while it does have a savings component too, it's also trying to get people to the right place to improve patient outcomes over time. The hospital readmissions policy, basically, Virginia already had one. It basically said that if you're readmitted within 5 days of discharge for the same or similar condition, you get no payment, because it seems likely that you might have been discharged a little too quickly. What the General Assembly approved this past session is it basically says for days 6 to 30 for the same or similar condition, if you're readmitted, that basically you only get half the payment for that. And part of this is to recognize Medicare has been doing a lot of work in trying to reduce readmissions. And I will note that there is a work group that was also set up as a result of this. It actually meets, I think, today at 3 p.m. But in some of the data they've reviewed actually shows that Medicaid, actually out of all payers, has the highest 30-day readmission rate payers. Medicare is a little bit lower, but Medicaid actually had the highest readmission rate. So it's definitely an area that needs to be looked at to try to improve, again, not just from a cost savings perspective, but also patient outcomes, because it doesn't help anyone to basically be released to immediately come back in a short time back into the hospital. So just to note on slide 27, value-based payment, if you hear this, I really just wanted to just make sure you hear that term. It's like traditionally healthcare has always been paid based on volume. The doctor's paid for every single person that they see, every office visit, stuff like that. And you may hear a lot about value-based payment strategy. So I won't go into great detail, but the idea is to pay on patient outcomes. So one of them that's been around for quite some time is bundled payments for maternity care. Basically, you get paid one fee for the whole cost of labor and delivery. If you have complications, well, that's too bad. You don't get paid anymore. The idea is that one is looking at averages, but the whole purpose is to try to encourage providers to kind of focus on how to improve patient outcomes, which in the long term, hopefully, would actually reduce healthcare costs. So just to note that, because going forward, you'll likely hear more and more of that, DMAS is working on quite a few of these strategies as well. On page slide 28, so this is just to look at like other healthcare options, what other states do. So for example, Massachusetts, which used to have the highest healthcare kind of cost in the nation, they ultimately created their Health Policy Commission. This basically, they look a lot of, they monitor the data so that they can actually make data-driven decisions. They eventually created in Massachusetts a statewide healthcare spending benchmark so they can measure things by. Maryland uses a global hospital budget, which they've used since the 70s, which basically is the state actually sets the payment rate for hospitals for all payers, from Medicare, Medicaid to commercial. And since 2014, they've even included a global budget cap in that so that they can kind of slow the growth in hospital costs. Vermont actually is implementing, and they've had some bumps in the road, an all-payer model that's broader than just hospitals, so it's everything. But it basically, and they're using accountable care organizations, which other states as well. Now, I'm not suggesting that any of these are things that Virginia should necessarily do. They're just, to highlight that there are a lot of things going on in different states to kind of look at how from a state perspective, can you look and better control healthcare costs. Certainly, I would say that monitoring and looking at healthcare cost data over time is always helpful, I think, to decision makers to understand if there's something going on in Virginia that's different and needs to be recognized. So just on slide 29 is just to summarize what I've already talked about, is Medicaid enrollment and spending is rising, but so far federal matching funds are covering those costs. The Medicaid forecast has a net general fund savings of about $188 million. Additional federal matching funds are possible, but still uncertain, and also a moving target. And just to note that next year's forecast will likely require substantial general funds unless Medicaid grows a lot slower than it currently is. And that all 50 states are facing similar trends in Medicaid. While in Virginia, though, because of the nature of our expansion and how it's paid for, in some ways Virginia is a little bit better off than other states when it comes to that. And just to note that, while healthcare costs have slowed in this decade, it is always prudent to continue to look at different strategies to try to control those costs and mitigate them so that we can kind of achieve the dual aim of cost effectiveness in Medicaid as well as improvements in patient care. So with that, Madam Chair, that concludes my presentation. And I know that I'm staying in the way of lunch, so unless you have any questions.
Are there any questions?
Madam Chair?
Senator Barker.
Yes, Madam Chair, Mr. Tweedy, quick assessment of the enrollment in Medicaid going forward once we get sort of past the current pandemic period. Seems to me that there are three factors that may actually drive Medicaid enrollment down. One is the ability to disenroll people who no longer meet the income requirements, et cetera. And that will go into effect as soon as we go back to the regular percentages of payment from the federal government for that. Second is that clearly during this pandemic period, as Charles noted earlier, A lot of the unemployment is among populations that had modest income to start out with, rather than the higher income population. And so that has clearly contributed to the Medicaid eligible population, both in terms of people who are unemployed and also people who have been moved from full-time to part-time. And then the third factor, which I think we will start to experience, I believe it's May of next year, is an increase in the minimum wage, which is, if it has the types of ripple effects that have occurred in other states, will help some people get to the point where they're beyond the eligibility and will hopefully be able to have private insurance coverage. Are those three all accurate, and is there anything beyond that that might help with the enrollment factors?
Madam Chair, Senator Barker, no, we concur. That is an accurate assessment of, I think, the different components of what could happen with enrollment, and all of those things could certainly occur. And actually, the forecast itself actually does embed, it assumes that when the health emergency ends in January, that there's probably about a 6-month disenrollment process that occurs. However, of course, every quarter that gets extended, the enrollment gets extended, but then it just delays that disenrollment period. But you're absolutely correct that all three of those are potential downward pressures on Medicaid enrollment, which could translate into next year's biennial budget being numbers be very different.
Thank you.
Are there further questions?
I have a question, Madam Chair.
Senator Edwards.
On page 24, you've talked about health spending in comparison with other countries. Health spending in Virginia reached 17.7% of gross domestic product, compared with 6.9% in 1970. And then you go on, compare healthcare spending with doctors and hospitals and so forth. Is there any way to capture, when you say spending, you're talking about how much the insurance companies are paying, or what? How do you capture that figure?
Madam Chair, Senator Edwards. So this information stems from analysis of national health expenditure data. So basically, it comes from actuaries at the Centers for Medicare and Medicaid Services. They do this every year. They're looking at national healthcare expenditures for everything. I would have to go back and look to see what all their sources are, but they're not just looking at what insurance pays, they're looking at what consumers pay out of pocket. They're trying to capture true and total national health expenditures.
Okay. But you're not looking at how much the insurance companies are making. Look, under the Affordable Care Act, they can only, the overhead is 15% or 20%, 15% for group policies, 20% for individual policies. Yet Medicaid or Medicare overhead is like 2%. Isn't that right?
Yeah, I mean, it certainly can vary year to year. Medicaid and Medicare, yes, definitely have lower administrative cost expenditures. And to your first, I think, point is, yes, I don't think that the health expenditure data necessarily captures any profits that the insurers make off of healthcare insurance premiums.
So if you compare how much the people are paying for insurance, if they're making 20% overhead, for example, on individual policies, or 15% on group policies under the Affordable Care Act, this is undercounting how much Americans are actually paying. Isn't that right?
Madam Chair, Senator Edwards, I mean, it's probably better if I go back and look at the data and see whether they capture that in any way, but I can definitely look into that for you.
Okay, thank you.
Any further questions? Okay, if not, we're going to break for lunch for 45 minutes, and we'll be back at 1 o'clock. Let's come back into session, everybody. I hope you enjoyed your lunch. And now we have a couple more hours of briefings ahead of us. We're back in session now. Okay. Let's see. Next, we have Tyler Williams, who is going to do COVID-19 impacts on K through 12 education. Tyler?
Good afternoon, Madam Chair and Senators. Today I'll be presenting on how COVID-19 has impacted K-12 education. Today, the presentation will cover the reopening guidance, how school divisions started the fall instructional schedules, their barriers to virtual instruction, enrollment loss, and a brief outlook on what we'll see in the 2021 session. Now turning to slide 4. As we all remember, in March, the governor ordered the closure of schools for the remainder of the school year. DOE and divisions worked to make sure that students that were promoted to the next grade level, if they were on track, and all students who were on track were able to graduate. In June, the governor released the phased guidance for reopening Virginia schools. The governor's office announced schools could reopen in 3 phases depending on the determination of the severity of the COVID-19 outbreak. The state is currently in phase 3, and I'll detail some more on the phases in the next slide. Overall, the recommendations emphasize gradually reopening K-12 schools and permitting in-person instruction under certain conditions. Before divisions could reopen schools, they were required to submit a health plan and a plan for providing new instruction. The Department of Education released the foundational guidance document, Recover, Redesign, Restart, to assist divisions for deciding when and how to fully reopen schools. This guidance is pretty comprehensive. It's approximately 130 pages, and DOE's guidance has not stopped since, and they continue to add more details to that. And one of those, and moving to the next slide, slide 5, in September, the department issued some updated guidance based on CDC. The CDC issued the dynamic school decision making, and the Department of Health incorporated these indicators that the CDC was recommending into the pandemic school metrics dashboard, which provided coronavirus indicators on transmission at a division level. The CDC indicators were then aligned to the phased guidance for Virginia schools, and the indicators serve as a starting point to make determinations on what to do in a school, but should not dictate the decisions that school districts make to best serve their individual communities. The CDC recommended 2 core indicators of disease transmission. The first, the number of new cases in the last 14 days, and the % positivity during the last 14 days. Those 2, along with a third indicator, the third indicator is a school's ability to implement key mitigation strategies, correct use of masks wearing, social distancing, hand hygiene, and contact tracing. Like I mentioned before, the indicators serve as a starting point. So if a division is facing the highest risk of transmission based on the indicators, divisions should consider operating in phase 1 of the governor's plan, which means instruction should be limited to students with disabilities, with everyone else being served remotely. And then divisions would need to continue to plan to phase back in person. If divisions were facing moderate risk of transmission, divisions should then consider phase 2, bringing back specific learners for limited in-person learning. This includes students with disabilities, English language learners, and our youngest learners, pre-K through 3rd grade students. And then finally, if a division is in a lower transmission level, they should consider phase 3, which serves all students in person if possible with mitigation and physical distancing. This is typically the hybrid schedule because of the physical distancing strategies. Turning to slide 6, since the beginning of school, DOE has been collecting the instructional schedules of divisions, and 50% of the divisions were starting the school year fully remote. This is 67 divisions. 25 divisions were delivering education in a hybrid model, some combination of in-person and some remote. 26 were partially in-person, meaning usually the younger grades were brought back, while hybrid or remote for all other students. And then 10 divisions were fully in-person. Turning to slide 7, with the majority of Virginia school divisions fully remote this fall, this meant that 80% of our students, or about 1 million, were enrolled in a division with a fully remote instructional schedule. This makes sense since 10 divisions enroll over half of all of Virginia's students. And all 10 of those divisions were fully remote. So when we think of the 10 largest divisions, Fairfax, Loudoun, Virginia Beach, Norfolk, Henrico, Chesterfield. So those kind of paint the picture on how many divisions, and those divisions were fully remote. I mentioned before, 10 divisions started the school year fully in person. However, most of those divisions were small, so they could serve their students. The largest division was Hanover, which enrolls a little over 16,000 students. It's important to remember, though, all students and families had the option to get virtual instruction, no matter if the school division was providing in-person instruction. And so the student enrollments here may not accurately reflect what each individual student decided this school year. Turning to slide 8, as of last week, 30% of divisions are still operating fully remotely. Several large divisions shifted their instructional schedules, Fairfax, Loudoun, and Virginia Beach. However, just this week, all 3 of those divisions have modified or adjusted their schedules once again. We'll continue to see divisions do this throughout the fall and winter as core CDC indicators influence divisions' decisions to respond to the pandemic and shift their instructional modalities. Moving on to slide 9, this just shows that by November, by transitioning 28 divisions from a fully remote schedule, only a third of students remain fully remote. Enrollment is a little more distributed across the instructional schedules, but it's important to remember students still have a full virtual option if that's how they opt to learn this school year by all divisions. Moving on to the next section, this is on virtual instruction. Transitioning to virtual instruction or remote learning has not occurred without some hiccups or barriers. This is a totally new situation for students, families, and their teachers. And moving on to slide 11, the biggest issue to remote instruction is the existing digital divide. As long as there has been a digital world, there's always been a divide. When thinking of digital, it is easy to simply think of access to broadband, but it also requires students have a laptop. Most smartphones are not capable of doing the tasks that students need to learn. And also cell phone providers providing mobile internet hotspots also are not as reliable as broadband subscriptions. Based on the 2018 American Community Survey, it's estimated nearly 1 in 5 Virginia school-aged children lack full digital access to broadband and a device. And looking at the map, the estimated percentages of households with school-aged children lacking a broadband subscription shows that this is a rural and an urban issue for households. The darker regions in the northern neck, south side, and southwest regions represent the households with children unable to get a subscription because of a lack of availability of coverage, while more urban households in Richmond and Hampton Roads are in the service or coverage area but unable to afford it. Because of this, broadband access is not available for 46% of children in households with incomes below the federal poverty level compared to 17% for higher income levels. 32% of Black children lack broadband access compared to 19% of white children. It's also easy to forget, but teachers also face the same issues, and 16% lack broadband access based on the American Community Survey. Turning to slide 19, divisions are working to close the digital gaps. Divisions move to provide devices and internet access to all students in a one-to-one manner. This was especially necessary for the younger grades since divisions did not previously issue devices for young children. The Department of Education estimated the need of about 428,000 devices and 124,000 mobile hotspots in May. The governor provided federal relief funds, $26.9 million in the federal governor's emergency education relief funds for devices. Virginia wasn't alone. Divisions across the country lacked laptops and Wi-Fi for their students. And so across the country, we see that there's a back order and worldwide supply delay of laptops. And Virginia's divisions, in 70 Virginia divisions, they're waiting on 52,000 laptops as of late October. Moving forward, though, DOE is now collecting in the student record collection every student's access to the internet at home, which will allow us to know exactly how many students have access to internet or do not have access, and this should help further connect broadband policy decisions with ensuring every student has access.
Let's stop now and see if anybody has a question on the first 2 sections.
Well, Madam Chair,
Senator Peterson.
I don't have a question. I have a comment. Maybe we're going to get to this. The digital divide is certainly something that's become salient. The other issue is if you have children with remote education that are under the age of, say, 12 or 14, you need somebody watching them. And this has become a huge barrier to working families, having to have somebody either to hire somebody or to have a child that should be in college or should be working to stay home with their younger siblings. It's going to be not just a drag on our economy, it's becoming a major impact on women in the workforce, all sorts of people. And that to me is as big a collateral effect as anything other than the lack of in-person education and the lack of everything else that goes with that. So this to me is the number one issue in the Commonwealth. This is not a question, this is a speech. But Madam Chair, thank you for giving me a minute of your time, but those are incredibly important issues.
Madam Chair,
They're important.
Question.
Madam Chair, it's Cree Deeds.
Senator Deeds.
Yes, I thank you for the excellent presentation, and I agree with much of what my friend Senator Peterson says. But I want to update you on Bath County. We always thought, because Bath County is listed as one of those 10 localities, it's always had 100% in-person education. We started out with a hybrid program, 4 days in class and 1 day on have 3-day weekends, which would allow for more time to clean the schools, clean the facilities. Last week, however, our numbers have bumped up. We were very proud to be the last locality in the state to report a case, but our numbers have bumped up. And as of Monday of this week, schools are closed. It's 100% virtual until the 20th of January. So that situation's changed since Tyler had his numbers. I know you all are worried with bated breath about what's going on in Bath County.
I am too. And Madam Chair, I have a question. If Cree's finished.
Senator Edwards.
Madam Chair, John Edwards here.
Senator
Madam
Edwards.
Chair, hello. Hello, John Edwards here. I have a question. Can anybody hear me?
Yes.
Can anybody hear me?
John,
I can hear you, John. I think everyone can. I don't know if Janet can. Can Janet hear you?
Senator Edwards, I've recognized you.
Okay, thank you. I appreciate it. I want to look at a line, page 11. Nearly 1 in 5 children lack full digital access, meaning broadband, I guess. 23% of all children, 311,000 children, lack access. Can you put that in terms of the rural areas of Virginia? What's the percentage of those who live in what would generally be considered the rural areas of Virginia that lack broadband access? Do you know what that is? I'm not hearing anything.
Madam Chair, Senator Edwards, I do have those numbers and I will provide them to you because I don't have them on top of my head right now.
Okay, thank you. Appreciate it.
Thank you.
Madam Chair. Madam Chair.
Who is it?
My name is
Okay,
Morrison.
Senator Morrison.
Thank you, Madam Chair. Question for Mr. Williams. Do you have a projection on the cost to the Commonwealth to bring these young children up to speed, for a lack of a more artful phrase, many of whom will necessarily lose almost a year or more of schooling? I say that because learning at the kitchen table, you put 4 kids at a kitchen table, my 4 kids, after a few minutes they're throwing things at each other, and they're not learning, and this has been going on since March of 2020. We very easily could go into 2021 with continued virtual learning. There is going to be a significant fall off in education. Is there a fiscal, there certainly is a fiscal impact to that, but have you been able to approximate what the cost it will be to bring these children back up to speed on the education that they have lost over the last year?
Madam Chair, Senator Morrissey, I think that is a big unknown as exactly the amount of learning that was lost. And I will speak to the academic impacts later, and so maybe that will help address your question. I don't have a fiscal impact, though, on the cost that it would be to bring them back to make up for that learning loss.
Madam Chair, one final point.
Senator Morrissey.
Thank you. This is not a question, but is also a short speech, very, very short. Many of the private schools in the Richmond metropolitan area are all in session. Catholic schools, they have virtually no COVID-19 cases. The teachers, no COVID-19 cases. These schools have 300-400 people. I hope that somewhere in your discussion we talk about why they are able to meet in school without contracting COVID, and we can't seem to do that in the public schools. Thank you.
Are there further questions?
Madam Chairman, Senator Donovan.
Senator Donovan.
Thank you, Madam Chairman. I just wanted to, and maybe you're going to talk about this in a minute too. There are a couple of things. One is, when we speak about virtual learning, we are not speaking about a homogeneous entity. This body has passed many times legislation and budget amendments to fund virtual learning in Virginia that would be across the board. And in fact, there is a platform that Virginia uses for Virtual Virginia that has been expanded graciously to cover any school districts that wanted to utilize that program. The advantage of the single universal platform is that number one, there's standardization of the classes that are on there for the state and for standards of learning, but also there's a vibrant opportunity for exchange of information. We've talked before about how many teachers are sharing lesson plans on Pinterest because they don't have a constructive platform on which they can share. There's also a lot of onerous documentation on multiple platforms for them with grades and everything else. Well, COVID has expanded that diversity in a way and that complexity because many localities have invested in their own programs because the state didn't have one. And they are working to varying degrees of success. And this is something that I hope COVID has emphasized even more to us, how important it will be for Virginia to have the nimbleness of a single platform so that this platform operates in the classroom as well as at home. So if a teacher has to transition for whatever it is, even just a snow day, it's a very nimble transition without loss of continuity in learning. So that's one thing I hope we're going to be talking about as we go forward. The other is to address Senator Morrissey's comments. We talked in this last special session about how are we going to measure kids. Every child is going to come out of this with a different academic achievement level. Some will have exceeded, some will have fallen behind. And the poorer localities do not have the funds to test individually the students. SOLs are great and necessary in some ways, but they're not a replacement for us knowing where each child is and figuring out how we can best individualize learning for that child to get them on the trajectory they need to be on to make up that deficit. So I hope we'll be looking at making sure we help poorer localities fund the ability to measure these kids. The Department of Education has processed a multitude of testing modalities that they have contracted to get at a lower rate for localities, but there are many, the localities in most need are still going to need to do that testing, but they can't afford to do it. So, and I would also echo the sentiments of some of the prior comments that data does not support kids not being in school. And the American Academy of Pediatrics does not support it, and school is much more than curriculum. And so this is, I agree, this is the number one most serious problem. I wish we'd dealt with it a little bit more during special session. Thank you, Madam Chair.
Madam Chair.
Senator McClellan.
Thank you, Madam Chair. I guess I have a question that is a little bit on the flip side of Senator Morrissey's question, and that is, will we have an estimate of what the fiscal impact would be of making ensure that all of our schools and public schools and school divisions have adequate PPE, contact tracing, cleaning supplies. Those that have poor ventilation can fix the ventilation, because I think we need to balance the cost to provide in-person education safely for all of our public school students against the cost of the learning loss. It's a frankly no-win situation. But I think we need to look at both sides of that equation. And I think hopefully when you look at the education loss impact of COVID, that you're also looking at, even for the kids that are in virtual school, here's a big difference. And I see it with my 5th grader, and in talking to his teachers, she sees it as well. One of the big differences between virtual learning and in-person learning is that it's not going to be fixed through a standardized platform of virtual learning, is the teacher can tell in the classroom when the kids aren't getting it and can slow down or do one-on-one with an individual child as necessary. They can't do that virtually, and they certainly can't do it on a uniform statewide platform. So I hope when we are considering how are we going to make up for learning loss, we are considering all of these factors and not just one or two in isolation.
Thank you. Are there any other questions or speeches? Okay, Tyler.
Moving along, Madam Chair, I hope to address all of those concerns in the next few slides. The divisions on slide 14, federal and state relief has been provided to divisions, a total about $738 million. A majority of this is from the federal funds related to the CARES Act. Just pointing out some things, in the CARES Act there was money for the governor's emergency education relief as well as the elementary and secondary school emergency relief. The Department of Education was allowed to maintain some of that money to give us competitive grants, and some of that money has flown to divisions to provide special education services and supports, mental health, social and emotional assessments of children, summer academies, upgrades to facilities, cleaning, as well as instructional supports, including diagnostic assessments that divisions could use to assess learning from students. Additionally, we provided state funds in the special session. This was the non-general funding from the gray machines that provided the relief payments for the local SOQ cost that increased because of the sales tax revision. Moving forward on slide 15, this gets to Senator Dunavant's point about expansion of Virginia's virtual learning platform. The state supported the transition to virtual learning by expanding Virtual Virginia with approximately $6 million in federal funds. Virtual Virginia originally was the state's platform to deliver virtual synchronous courses for high school students that were not available to them at their home high school. However, this expansion has made the program more than just the 9th through 12th grades, but K through 5 and 6th through 8th grades. It's doubled the number of free student enrollments for high school students in the Virtual Virginia teacher-led courses. Those are Virginia teachers teaching Virginia students. It's also provided all educators access to a learning management system at no cost, so it is safe to say that every division has a learning management system now that they can use for virtual instruction. It's expanded course content for K through 12. This is also going to provide asynchronous courses for all grades and all core subject content that can be used offline. So what that means is it will allow a student to download materials in a parking lot with Wi-Fi, a school that's been equipped with Wi-Fi, a library, anywhere free Wi-Fi is available, the student can download that schoolwork, complete the work, and when they get temporary access to the internet again, re-upload it for evaluation. This will assist in ensuring instruction is not interrupted because of students not having access to broadband, or if there's any further need for school divisions to restrict in-person learning because of the pandemic. So that covers the Virtual Virginia transition. Moving on to slide 16, I'm now going to talk about the outlook for the 2021 session and the academic achievement impacts. A complete picture has yet to emerge of how much learning was lost by students during the pandemic. The Department of Education anticipates compounded learning loss. Typically over the summer, students lose learning gains in reading and math, referred to as the summer slide. This year is different as students were out of school for 2 additional months without educational supports in some places. So the general academic consensus from the researchers is students likely return to the classroom or the Zoom this fall with lower learning gains in reading and math relatively to a typical school year. The lower learning gains are probably higher for students who had difficulties accessing remote learning, particularly students of color and rural and low-income families facing the worst inequities of the digital divide. This year, educators' top concerns is figuring out where students stand now and providing supports where needed. Educators will likely need to consider ways to support students who are academically behind and further differentiate instruction. Assessments this year will need to be diagnostic and low stakes to differentiate instruction. We do know the SOL tests are not sometimes diagnostic, but the state will still administer the test as required by federal and state law. And accreditation has been waived for the 2021-2022 school year, which would have used the data from this school year's test. Moving on to slide 18. This slide we've seen before. This is just the special session budget actions. It's really just here for your acknowledgement that remembering that we included a net increase of $1.3 billion in the original budget adopted in April with $490 million unallotted. Most of this was for the salary increases for teachers. And then the special session, we restored some second-year funding for the early childhood expansion and at-risk students to support the at-risk students in divisions. Turning to slide 19, this is the outlook. Enrollment is down across Virginia. It's decreased about 38,000 students compared to last fall. The next slide will provide more details on that. The digital divide access will continue to still be a discussion and the ongoing cost needed to provide one-to-one devices. Like I mentioned, Virtual Virginia was expanded. We used federal funds, so to continue that expansion, general funds would be needed. Child care and early childhood access remains a concern. Its availability will be key to the recovery for parents, especially for women, as their labor force participation rate has not recovered as quickly as compared to men. And 30% of providers still remain closed today. And so a big concern is how many of those will not return. Special education will also be a discussion topic during the special session, or not the special session, the session, sorry, with the special education study forthcoming from JLARC and the recent CSA study from JLARC. Prior to the pandemic, the state had teacher shortages, but how has the pandemic further impacted them? Are we seeing additional retirements this year or unfilled positions? And this also brings up the teacher compensation portion of teaching supply and demand. And then the next rebenchmarking will be in the 2022 session, so a budget pressure in the next biennium. Moving to slide 20, this is the K-12 enrollment. K-12 fall enrollment has decreased 3% compared to fall 2019, or almost 38,000 students. For historical comparison, from fall 2018 to fall 2019, enrollment grew slightly above 0.5%. Historically, enrollment has been flat or low growth. Most divisions experience declines in enrollment, except for a few divisions experiencing increases. If you're looking at the map, those are the blue divisions. Almost all of the increasing enrollment is attributed to 2 localities, Richmond and Radford, due to students enrolling in a virtual program delivered by an approved multi-division online provider through the division. When we look at the 38,000, kindergarten alone represents about 30% of the overall decline, or about 12,000 students. This is partly attributable to the code allowing parents to delay enrollment for kindergartners by 1 year if they determine the child is not socially, emotionally, or physically able to attend school or ready for school. And obviously the enrollment has funding impacts, and that will be a consideration that the General Assembly would consider during the 2021 session. And we will continue to monitor how the governor addresses the enrollment loss in his introduced budget. And before I stop and we turn it over to questions, behind the slide deck, members, there's a spreadsheet on the division by division enrollment loss if you're particularly interested in a certain division. And with that, Madam Chair, I will turn it over to questions.
Are there questions? I'm not hearing any, so thank you, Tyler. Next, we're going to hear from Sarah Herzog on higher education.
Thank you, Madam Chair. Normally, when the economy is in a recession in a way that affects state revenues, there's not also a simultaneous acute impact on other higher education revenues, tuition, enrollment, and auxiliaries, all at the same time. So it has been a year of tremendous uncertainty, and the wait and see continues. As of today, with most public colleges in Virginia wrapping up their in-person classes either this week or next week, we know better what we know, more of what we don't know yet still, and more of what we'd like to know going forward. The next slide, to orient you, this presentation mostly follows a chronological order, spring 2020, fall, and beyond. There's some overlap in some places. And in each section touches on the learning or operating impacts as an in-person versus virtual, the enrollment impacts, and the financial impacts, all of which are interrelated. On slide 4 now. And the left side lays out generally the key items in each of the buckets in the presentation. And I'll begin first, taking you back to spring 2020. And this was the time when a lot of campuses were actually in the middle of a spring break, so some spring breaks were extended, classes were shifted from graded to pass-fail, and Zoom became a household word. And because of the campus closures, it impacted both revenues on the auxiliary side, as there were quick refunds made for housing, dining, and parking, and also on the expenditure side for all things related to COVID, the online learning, telework, PPE testing, and cleaning. One of the things we know now as FY20 has concluded and the spring semester wrapped up is that the Federal CARES Act funding did significantly mitigate the immediate fiscal impact for the institutions, and statewide on a net basis resulted in just about a $26 million decline, and it did vary by institution, with some slightly positive with the federal funding. And this was based on information provided by the institutions to SCHEV in July, and this went through their revenue loss, additional costs, offsetting savings, and the additional dollars available to come to that calculation. So the next 2 slides will be briefly recap the Federal CARES Act funding as it relates to higher education. And slide 5 is a recap of the 6 different key kinds of federal relief, so that the table on the next slide will make better sense. Again, the session here ended on Thursday, March 12th. By March 27th, the Federal CARES Act was signed, and by April, the U.S. Department of Education had begun to make allocations of the funding. Under the larger umbrella of the higher education emergency relief funding, there were 4 key pieces, the largest being institutional flexible aid and student aid, and that was done quickly by formula to institutions based on their enrollment with an emphasis on their Pell enrollment. Half was for the flexible institutional aid, which was largely used to backfill those auxiliary or dorm refunds that were made quickly. The other half was required to be used for emergency student aid and could not be used to cover the institution's auxiliary costs. To give you an idea of the magnitude of that amount, it equates to about $350 per full-time student, although institutions made the decision about exactly how to allocate to which students, so it was not distributed on that across-the-board basis. There was also funding for minority serving institutions and a funding pot at the discretion of the U.S. Secretary of Education. Beyond that, the larger pot for higher education was the Governor's Emergency Relief Fund that Tyler mentioned for governors to allocate between K-12 and higher education. Virginia's $66 million, about $23 million was allocated to higher education by the governor for the items noted on slide 5. About $14 million was essentially for student financial aid on a similar basis to what had been in the 2020 budget. Some funding for tuition assistance grant eligible institutions, a few different items related to community colleges, and a smaller amount for the centers. And then last, the Coronavirus Relief Fund, CRF, was not specific to higher education. It's part of that larger funding stream, but there were allocations from this made to institutions for their reimbursable expenses related to COVID costs. So slide 6 shows in table form and by sector, meaning the type of institution listed along the left side, just for your reference. I'm not going to go through every single number here, but just to walk you through how it's set up using the first row on the public 4 years. There you see that 50-50 split from the two biggest pieces, $69 million for flexible institution aid and $69 million for student emergency aid. $24 million for the 4 years for minority serving institutions, HBCUs. The smaller amount for the U.S. Secretary of Education funding. There you see the governor's funding I referenced. And then the last column before the total is the CRF amounts. And this table really represents the first round of this back in the spring. The subheading and the notes reference the amounts that were allocated later, and I will come back to that when I get to the special session. So now turning to fall 2020, after we've had commencements postponed and everything else looking ahead, prior to the true start of the new semester in the fall, beginning in the summer, there were some soft reopenings as limited clinical classes began to be allowed to be held. Some sports began to practice and RAs began to return. On slide 8 gives a sense of some of the reopening components. All the institutions were required to submit their plans to SCHEV to review and certify. Those were due July 6th and had to include certain guidelines that they had considered related to 4 areas: repopulating the campus, monitoring health conditions throughout the semester, containing the spread when detected, and shutdown considerations. In terms of their schedules, many delayed their opening dates, days or weeks, and altered them further as the date approached. Some had initial open for a brief period that was either online or hybrid to allow for more staggered move-ins with quick move-in windows. And at least one did open regularly as scheduled. The chart on the right tries to give you a sense of how much was in person versus online, and enrollment itself is not tracked in this way cleanly. And we know there was every possible combination, such as students taking virtual classes, possibly all of their classes for the semester on campus from their dorm room, alongside students that may be taking their classes virtually in another state and had not come to campus at all as well. So generally, the ones at the top would have had reported more in-person classes than the ones at the bottom, but I wouldn't be too precise about the way they're lined up per se, given the variability in how the exact hybrid classes were delivered. Back to the bullets. Because of the situation, dorms were at lower capacity, or occupancy might be a better word here. And this is information that's not normally collected and tracked closely at the state level, but it's such a different situation this year with there being a larger impact on auxiliaries even than on the tuition side. So to follow up from the October committee meeting, I had asked SCHEV to begin to compile some of this, and we have gotten some of this in, and the subcommittee may wish to delve into it further. Almost all the institutions were operating at a lower number of beds than usual in terms of their dorm capacity. And then in terms of the end of the semester, most had planned all along for a late November Thanksgiving-ish end to in-person. So now moving to slide 9, after that quick spring change to online and how will colleges operate, the next question is what will students and families do? Will they enroll? Will they show up? And this is kind of aligned along 3 key timelines: July, September, and November. In the summer, with the special session approaching, institutions were surveyed as to their range of minimum and maximum expectations. Back to the analogy from this morning about the Jell-O and the additional nails and trying to anticipate what the range of actions might be. And again, these were due July 31st. One institution, just to give you a flavor for what they were, said they might expect a loss of half of their out-of-state students if people simply aren't willing to travel, a smaller loss of in-state, sometimes using words like potentially catastrophic in their submissions. And in terms of revenue, the midpoint of these early sort of best and worst case estimates was a loss of about $150 million in tuition revenue and $350 in auxiliaries. That's about 5% and 20% reductions respectively. And the range was about $1 billion total to closer to break even from the prior year as a best case scenario. So a very wide range there. Then by the very end of September, we had the initial early enrollment estimates that Chev was collecting as the calendar had gone through and we were getting past the drop deadlines for campuses. And there was a bit of a sigh of relief that for the most part it was not those worst case scenarios in terms of enrollment in the classes. But that's when we began to get a picture of the detail under the top line numbers. Looking at the difference, not surprisingly, in out-of-state students, notably first time in college, which I will come back to in a moment, and there appears to possibly have been a shift in part-time versus full-time students to look at too. So now in November, we have in the initial official fall headcount enrollment submissions for the public 4 years. Community colleges have a little longer to submit as they have a later 8-week semester, and the private college actual numbers are not finalized yet. On slide 10, this is from the September early numbers, but I show you this because it at least gives you the cumulative number in those two middle sets of bars for the community colleges and for the private 4 years. The second from the left for the public 2 years does show nearly a 10% decline in headcount enrollment, and this would not be what we would typically expect to see in a recession. Often community college enrollment is counter-cyclical with a downturn, but it could be a different dynamic this time in terms of students that may have children in school and families and essential jobs in terms of their continued enrollment. Although there was some idea that initially that summer enrollment had been up. And then as far as the private 4 years, this shows an increase, but it's important to note that that includes the single largest private college in Virginia, Liberty, which did have an increase. And so there's obviously a lot to look at with those two, but the next two slides will focus on the public 4 years, since that's now the official data that we begin to have in hand. Turning to slide 11, these bars are on a different basis. The previous slide was year over year, and now what you see here is in blue is the total in-state undergraduates for the institution, and in orange is their total out-of-state undergraduates. So just visually, the first thing you see is which are the largest institutions in the state, and get a sense that the proportion of out-of-state enrollment varies significantly. Then in terms of the change of enrollment, the percentages at the top of the bar is what shows the change over year. And in terms of in-state students, most actually did increase. And in terms of out-of-state students, most, but all decreased. And there were 4 institutions that had decreases in both, with both of their percentages being shown in red. I'll also note that these are rounded here just for your simplicity in viewing it, but 0.5% increase for an institution would be very significant to them versus it being a whole percent. So there may be a few of those that are rounded significantly. So as much as there is to look at on just this one chart, the next on slide 12 breaks it down further. As the committee first heard from Peter Blake last month, the first time in college enrollment decrease was larger, maybe similar to the kindergarten situation just described. Here, the blue bars do represent the percent change in state undergrad first years, and orange, the out-of-state first years. And the percentages are just on the blue bars this time. And the reason that these were down, but the overall percentages were closer to level, was that there was a bit of an increase in retention of current students compared to the prior year. So sophomores and juniors may have chosen to stick with their current situation compared to a more typical year. With that quick overview of enrollment, shifting gears a bit to tuition and fees for this school year. 12 out of the 17 institutions did, in the spring, freeze their tuition rates at the prior year. And so you see just a small, about 1% increase statewide in tuition and mandatory fees, given that a handful did proceed with their previously planned tuition increases. And the community colleges amounts were frozen also. On slide 14, moving to the state budget, and again, this is a similar slide that you saw for the conference report. Thinking back to your budget in March, it had an increase for higher education of nearly $300 million, nearly all of which was unallotted, that temporary measure in April, the month of April, and not restored in October. And these were the initiatives that you recall spending a lot of time talking about in the regular session: the Last Dollar Plus, Community College Workforce Initiative, G3, additional need-based financial aid, an increase in TAG grants, and an incentive funding pool for additional tuition moderation. So instead, the conference report provided about $94 million general funds and largely flexible funding, and most of that was one-time funding in the first year. And there was new language allowing flexibility to support auxiliaries with the education and general balances if available. And because this was such a departure from the usual situation, there was also new language related to looking at overall financial health measures at the same time, which I'll come back to on the next slide. Just briefly, most of the new FY21 one-time funding was provided on the basis of trying to provide nearly half of what each institution's midpoint estimate had been of their July estimates, or other adjustments like a minimum percentage of their total in-state undergraduate revenue. As I mentioned before, there was also some significant additional CRF allocations done this fall in the conference report. The amendment included $120 million in CRF funds for higher education, and then after the conference report, the administration announced $30 million for the VCCS initiative entitled REV for reemploying Virginians for scholarships for workforce programs, and $22 million for private colleges. On slide 15, a little bit more information on the measures of institutional financial health, which was paired with that significant temporary flexibility regarding auxiliaries. In 2017, the Auditor of Public Accounts compiled a comparative report of certain financial health measures for things like reserves, viability, there's a composite measure, and auxiliaries, and included comparisons to other states. And they were working on a new report this year with 2019 data, which is due out in the coming weeks. And back in the 2017 report, there were some of the measures that were below the benchmarks to look at. And there's various reasons for institutions being situated differently in terms of their age, size, geography, and their particular mission. But the new language calls on SCHEV to collect from each of the institutions a financial sustainability review and possible action plans after they've reviewed their comparison with the measures. And the subcommittee may want to look at this further in terms of a longer outlook, even beyond the short-term biennial budget, because these are indicators that will be pre-COVID indicators. As usual, each fall, SCHEV provides budget recommendations for consideration, and I will also touch on the proposed debt restructuring, which would impact 3 fiscal years, 21, 22, and 23. On slide 17 is a summary
Let me interrupt you and see if there's any questions for
Madam Chairman.
up to now.
Surville.
Senator Surville.
Thank you, Madam Chairman. So I saw on one of the previous slides that I think you said the shortfall in auxiliary monies was $350 million. And how much of that was athletics versus other parts? I mean, I'm assuming the decline in ticket revenue and TV revenue and all that's been pretty substantial.
The 350 referred to the midpoint of their best and worst case planning as of July. So that is not an actual number. That's what we're continuing to look into now. And I do not believe what we initially received was broken down by area in a lot of detail, but I can look further into athletics specifically. It varies by institution to the extent that some have more reliance on athletics than others, and fall is a bigger athletic season than spring was. So I can follow up a
Right.
little further on athletics.
Additional question,
And
Madam-
athletics was specifically excluded from the language allowing E&G balances to cover
Right.
auxiliaries.
That's what I was getting. Additional question, Madam Chair?
Yes, Senator Serval.
Thanks. So that's what I was getting at as somebody who's paying for 2 in-state college students right now, but if they can't use the E&G money to make up for the shortfall, how are they expected to make it up? Because I would assume that a lot of the athletic shortfall is probably fixed costs, things like scholarships and stuff. So, are you all going to ask for, students, or the college is going to have to ask for students next year to cover some kind of athletic debt from a prior year?
The restructuring of debt that I'm going to talk about is related to auxiliaries too, so I'll get to that in a moment. But as we're just in the middle of the semester, it wasn't clear exactly how the whole semester would play out. So even just now, we are about to send out a second request similar to the assessment that I referred to in FY20 in terms of how all the different changes of revenues, expenditures, and additional funding played out. Now, even though this semester is not completely closed, we're going to do a quick survey to hopefully have in time for January in terms of how the fall looked like. But, there's the full fiscal year and spring to regroup too. And institutions are making different operational decisions on campus in terms of what they do.
Okay. Thank you.
Madam Chair.
Madam Chair, John Edwards here.
Senator Peterson.
Thank you, Madam Chair. A question, and I come from the same perspective as Serval, as having 2 daughters at a public university here in Virginia. I noticed that our incoming freshmen has decreased 8%, our first-time in-college undergrad students. And that brings me to my point that what is our numbers on dorm utilization? Because it seems to me all of these kids that are not coming to school would be kids that would normally be in dorms, and then a lot of the remote learning means that they are staying at home as opposed to living in dorms. And since this dorm construction is backed by, I believe it's backed by the state credit, if it's a 9D bond, what is the impact on dorm utilization, and where do we go on that?
Yeah, as I mentioned, we did follow up after the last meeting with the question about the extent of dorm capacity. Typically, most institutions had occupancies in the 90% the previous fall, and most, with one big exception, definitely had reductions in occupancy this fall, although I think that all were somewhere between kind of the 50% range and the 90s. And overall, it was, just to give you an idea, this is preliminary, but on order of magnitude, maybe like a 25% reduction in occupancy. I do have some information on hand if you're interested by institution that I can follow up with you later.
Let me just give you a very precise question. Are any of these institutions in danger of going into default on their bonds because of a lower dorm utilization?
I'm not sure I can answer that without asking specifically. They all did have occupancies over 50%, and on the next few slides I'm going to show the proposal to have basically 2 years of deferred payments on their debt payments related to things like their revenue producing facilities, so dorms and other things. That savings is estimated to be about $300 million over 24 months, so that should provide substantial relief on the auxiliaries.
Senator Edwards.
Hello, John Edwards here. Can you hear me?
Yes, Senator Edwards.
Okay, I have a question on page 13. You have the four-year in-state undergraduate schools on average about $25,000 altogether, tuition and fees. The community college is about $4,600 roughly altogether. With regard to the four-year schools, what's the out-of-state average student paying, and what are the actual costs to the universities for one person for 1 year at the universities? Do you have that?
We do. The annual tuition report that Chev puts together has the out-of-state amounts, the averages, and by institution. I'm not sure I'm going to be able to guess the average total off the top of my head. I can look it up and follow up with you about that, and it varies by institution too.
And the cost?
Cost is a trickier question to get at in terms of whether out-of-state students in some ways may be paying, a bit more than the cost since the in-state students are subsidized. I can talk to you further about that one later if you like.
Yeah, thank you.
Any further questions? Okay, Sarah.
Thanks. Back on slide 17 on Chev's budget recommendations for FY 2022. Given the overall fiscal situation, their approach this time was pretty straightforward, and they just focused on some options for essentially restoring what had previously been in your 2020 budget. And if you wanted to restore all of it, it's cumulative. You'd essentially add priority 1 plus 2 plus 3 to get to the total, so approximately $136 million to essentially restore what had been removed from your original budget for FY22. The priority 1 items, we're trying to focus first on the most vulnerable students, focusing on need-based aid. With priority 2, then adding on getting people back to work, and then 3, all the remainder of the new initiatives. Slide 18 refers to the debt restructuring that I did mention. The administration announced in late September the opportunity to do some significant higher education debt restructuring that could provide about $300 million in relief from deferred payments over 2 years. And because interest rates are at such low levels, there was a pretty low net present value cost to doing this restructuring at the time. The 9C piece of it, so things like revenue producing dorms and the like, would require General Assembly approval in the 2021 session. For the other piece, the 9D, other non-tax supported debt, would not require specific approval. The chart on slide 19 shows by year. So if the 9C piece were approved in the 2021 session, it's about $65 million of deferred payments for that year. Then with both pieces kicking in with the June and September payments, about $150 million in 2022. And then over the 24-month period, there would be still some savings in the next biennium, about $95 million in 2023. On the last slide, this tries to wrap up by mentioning that given what we now know, some of the key known unknowns are related to what the learning outcomes are. What is the impact of the digital divide here? And there is a similar digital divide. The numbers generally are a little lower in terms of the number of college students that don't have access to broadband and devices, but there is still a digital divide there. With Tyler's reference to 1 in 5 students not having both. And then also, what are the lasting lessons learned from this rapid pivot? You may want to ask institutions and presidents for some of their initial thoughts on an after-action review from their lessons learned from this unprecedented situation. In terms of enrollment, looking at some of those details I mentioned in terms of whether there could be long-term impacts or it's really just temporary short-term impacts. In terms of out-of-state students, the first-time students, if there may be a bump in a year or two as students jump back in and attend for the first time. What are the actual revenue estimates now that we are closing the semester, and we are going to be asking for that shortly? What will spring look different or similar? And how have institutions and students been impacted differently? Related to all this, is there also a looming enrollment cliff that's layered on top of this that we were discussing predating COVID in terms of looking at the out years for how many high school graduates are in the pipeline coming to college in coming years? And then financially, the questions are, what is the level of additional requests for FY22, and what role would you want campus realignments to take relative to additional state funds? And then how should student need be weighed against other operating requests? And it may be that as we dig into some of the differences in institutional impacts, they're really reflecting differences in the underlying students that typically attend that institution in terms of their financial situations. And that concludes the presentation.
Thank you. Are there further questions?
Question, Madam Chair?
Is that Senator Favola?
It is.
Okay.
It is. Thank you. April, quick question. I'm just looking at the recommendations, SHEV, budget recommendations for fiscal year 2022. I guess there's no expectation that we're really going to see an increase in workforce training or some of the community college programs that many folks access when the economy is, having a downturn or there's a realignment, which it looks like we're going through. So do you have any information on what might be happening or anticipated with workforce training programs and other like-minded curricula at the community colleges?
Madam Chair, Senator Favola, the SHEV recommendations do recommend restoring the G3 initiative ultimately, although not in that very first group where they mostly just included the financial aid, and they kind of did half and half for priorities 2 and 3. I believe these came out prior to the announcement about the REV initiative, which is similar, that allocates $30 million of the CARES Act funding for workforce scholarships for students that apply by December 14th. So that is a significant amount in a short period of time.
Thank you. I was wondering about that. So you answered my second question. So thank you.
Okay, any further question? Not hearing any, we will take a 10-minute break until 20 minutes after 2. And at that point, we'll hear the very important transportation report. on transportation, and then April Keys will give us some updates and announcements, and then we'll be finished. Jason.
Thank you, Madam Chair. One of the benefits of being the last speaker is that I get to listen to everybody else that's spoken during the day and reflect on some of the points that were made and how it informs your decision-making process here. And one of the things that I heard from Dan White first thing this morning was, while the economy is not good, it is less bad than we thought. And as I listened to Senator Saslaw, Senator Peterson speaking about the fact that essentially you've done 4 budgets in 1 year using 3 forecasts, in transportation, you'll be happy to know that you are going to measure twice and cut once, because being non-general funds, the budget that you just did in House Bill 5005, we did not adjust transportation revenues. You merely provided flexibility to the Commonwealth Transportation Board for the programming of those revenues. Next slide. Virginia's 7 multimodal transportation agencies are responsible for delivering and maintaining highways, seaports, airports, ensuring the efficient movement of people and goods, assisting in the development and delivery of mobility options, ensuring the safety of drivers, and collecting revenues from taxes, licenses, and registrations to fund those operations. In addition, direct and indirect employment in the transportation sector totals more than 500,000 jobs. Included within the $9.7 billion appropriated funds for fiscal year 21 are revenues from dedicated state and federal taxes, funding from driver's licenses and vehicle registration fees, terminal revenues generated from the business activities at the Port of Virginia, and concession payments from the private vendors and regional transportation entities that contract with the Commonwealth to deliver transportation solutions. Next slide. In the next 15 minutes or so, I will recap the transformational funding and policy changes adopted during the 2020 session, provide a brief overview of the evolution of regional transportation funding programs, discuss the impact of COVID-19 on transportation revenues and programmatic expenditures, and provide a brief outlook to the 21 session where hopefully there will be few policy changes and the revenue picture will begin to bring some more certainty as we move forward with the budgeting process. Next slide. Picking up on slide 5. During its 2020 session, the General Assembly enacted 3 separate pieces of legislation that together provide for a comprehensive statewide and regional funding program that was forecast to generate approximately $1.2 billion in new revenues over the biennium. Senator Saslaw patroned the governor's omnibus transportation bill, Senate Bill 890, which revised the composition of and increased available revenues for transportation funding in the Commonwealth. This was accomplished primarily through increasing motor fuels taxes while providing some offsetting reductions in vehicle registration fees. In Northern Virginia, slight adjustments to the grantors and transient occupancy taxes that were currently levied were intended to supplement existing dedicated regional transportation revenues. Senator Lucas's SB 1038 provided additional dedicated funding for transit programs in Hampton Roads through the imposition of new regional grantors and transient occupancy taxes, similar to those that were already imposed in Northern Virginia. Finally, Delegate McQuinn's HB 1541 established the Central Virginia Transportation Authority, which is assumed to provide around $350 million over the biennium from regional sales and gas taxes for transportation projects in the Richmond region. As illustrated on the table to the right, the trio of funding measures was anticipated to generate more than $1.2 billion in new state and regional funds over the biennium. I would note that of these new revenues, only the top row, statewide formula funds of around $525 million, are fungible enough to address shortfalls for statewide programs related to COVID-19, while the remaining funding buckets are dedicated to specific and restricted uses. Next slide. The omnibus funding legislation established a dynamic statewide and regional revenue stream which standardized motor fuels taxes for both statewide and regional transportation programs, including those areas where they were not previously imposed for regional authority. You increased the gas tax by 10 cents over 2 years, and when fully implemented in fiscal year 22, you will have a uniform state and regional gas tax of 33.8 cents per gallon. From that point forward, both state and regional motor fuels will be indexed to the consumer price index instead of the sales price of fuel, allowing fuel taxes to adjust revenues as the cost of materials increases. You also established a very progressive highway use fee for highly fuel-efficient vehicles, which I will explain in a little more detail later in the presentation. To ensure equity to the consumer, you reduced most passenger vehicle registration fees by $10 and eliminated an additional $5 in-person DMV service fee for folks that walked into a DMV office, which you can't do very easily these days. And additionally, you authorized $2 billion in transportation debt instruments that are not included in the Commonwealth's debt model, that are backed by dedicated revenue sources to accelerate improvements to both Interstate 81 and to increase passenger rail capacity throughout the Commonwealth. Next slide, please. As you can see, the increase in gas taxes, which in some jurisdictions was as much as 12.6 cents a gallon, do not appear to have affected gas prices. I will point out Virginia, for example. In March of 2020, average statewide gas price was $2.06 a gallon, and our weighted tax, including taxes that were state taxes and the existing regions at that time, was 22 cents a gallon. With the tax increase that went into effect in July, the state of Virginia's gas tax rate is now 29.4 cents a gallon approximately, with an average gas price of $2.02, or a decline of 4 cents a gallon. I'll contrast that with North Carolina, who actually saw a gas price decrease of roughly 13 cents a gallon, while their tax rate remains more than 7 cents higher than Virginia today. Turning to the next. Changes to the revenue sources adopted last year have provided a more balanced funding portfolio that is not overly dependent on any one revenue source. The diversification of revenue streams has in turn helped to make the Commonwealth Transportation Fund more resilient. For example, actions taken in 2013 to increase dedicated sales and use tax revenues to transportation programs have provided stability in core programmatic funding, while increases to motor fuels tax rates adopted last year have helped to mitigate the decline in motor fuel consumption resulting from decreased daily travel and safer at-home approach to controlling the spread of coronavirus. The legislation unified and simplified the Commonwealth Transportation Fund, and as you can see, the burden is shared equally between retail sales, motor vehicle sales, motor fuels taxes, and then all other revenue sources. Turning to the next slide. These stable state revenues are critical to financing projects. Transportation projects are planned over a 6-year planning horizon, and annualized changes in revenues have a meaningful impact each year, but are best considered over the long 6-year planning horizon, and typically forecasting of transportation revenues when you're considering legislation, it's looked at over a 6-year planning period. I would note that the $3.5 billion Commonwealth Transportation Fund is approximately half of annual transportation revenues, that the second highest source of funding is actually local and regional project participation revenues. This year it's driven a lot by Hampton Roads Transportation Accountability Commission's contributions to contracting with VDOT for the construction of the Hampton Roads Bridge Tunnel. But it's also revenues from things like the local revenue sharing, which match state funds on a dollar-for-dollar basis to deliver small local projects. I'll talk a little bit more about that program in a few minutes. And federal revenues are actually the third largest source of funding for annual spending on transportation in Virginia. I would note that federal revenues today are stable at the fiscal year 2020 level, and that is due to the continuing resolution which was signed by President Trump on October 1st. We'll note that that continuing resolution does expire in December. And the initial spending plan, which has been put before the Commonwealth Transportation Board at its last meeting in October, contemplates appropriating approximately $495 million from prior year funding from the revenue sharing program, which was contemplated in the language that you all adopted in the special session. Moving on to the next slide. But what you really accomplished was this. This was how transportation funding worked prior to the legislation passed last year. There were fragmented sources of revenue allocated to specific purposes, and it was very difficult to track how much money came in and what went to each program. So if you turn to the next slide, you have now unified, streamlined, and simplified that program. All of the transportation revenues, state levied, now go into a unified Commonwealth Transportation Fund that After several off-the-top allocations for things such as the Route 58 Corridor Development Fund, the Northern Virginia Transportation District Fund, Northern Virginia Transportation Authority, and for the newly established Special Structures Program, is then split 51% for highway maintenance and operating and 49% for the Transportation Trust Fund. Next slide. Within the Transportation Trust Fund allocations, those formula distributions were changed last year to address key programmatic needs. You have now established specific allocations for all modal agencies, including the Department of Motor Vehicles and the Virginia Commercial Spaceflight Authority, both of which did not have any dedicated ongoing source of revenue from the Transportation Trust Fund prior to last year. You provided additional smart scale funding, particularly in districts without regional funds, by creating new construction district grant programs in all of those regions with dedicated funding. You increased transit funding by approximately 45%. You addressed the long-term needs of special structures throughout the Commonwealth. You fund the WMATA Metro PREA match, which is a federal match program in which the state matches money from the District of Columbia, the federal government, and Maryland for the operations of Metro. And you increased funding for pavement maintenance and other day-to-day operational programs at the Department of Transportation. Next slide. I'd like to briefly speak about the highway use fee, which is an innovative and progressive approach to capturing use of the roadway. So the highway use fee, or HUF, is a calculation that is based on 85% of the difference between the fuel tax paid by an average vehicle, which is 23.7 miles an hour per gallon, and the fuel tax paid by a more fuel-efficient vehicle. And you repealed the $64 electric vehicle registration fee. So the chart on the right is a stepwise calculation of how you get to the highway use fee. So if you're an electric vehicle that consumes no petroleum, the average vehicle pays approximately $103.76 in gas taxes per year based on those assumptions. 85% of that difference is $88.20. So the new electric vehicle registration fee essentially is $88.20. If you drive a car that gets less than 23.7 miles a gallon, you just simply pay you don't pay a highway use fee at all. You just pay gas taxes. And as your vehicle's fuel efficiency increases, you pay an incremental increase based on that difference between your average annual taxes and the difference from the total amount. So if a car gets 25 miles a gallon, its annual highway use fee would be approximately $4.59. That can then be further calculated into an approximate charge per mile. So if you're interested, or you have constituents that are interested, next slide, please. You also contemplated the creation of a mileage-based user fee pilot program as a voluntary program for individuals that would be more interested in paying by the mile because they believe they drive less than that average calculation. Because it is difficult to ensure things such as the protection of personal information, methods of reporting, and various programmatic administration of fee collection. This is a 2-year-long work group that is currently ongoing. Interim report is due on July the 1st from the Department of Motor Vehicles with a planned program implementation of July the 1st, 2022. So certainly as you all travel the roads of the Commonwealth, please consider participating in the program. I'm certain that they need volunteers. Next slide, please. The reforms that took place last year also focused on changes to mass transit funding, which really increased the focus on operations. Ensuring that Metro had a dedicated allocation was accomplished in 2018. So when you look at the pie chart on the right, the 46.5% of all transit funding dedicated to Metro operations and capital was a decision that was made in order to establish a floor and to allow all of the other transit properties across the Commonwealth some certainty in the amount of annual funding they would be competing for. Last year, you grew the size of the pie by 45%. So it wasn't any action specifically dedicating funding to WMATA as much as it was, growing the overall program, which includes operating and assistance and capital grants, as well as new innovation and incentive programs. One of those innovation and incentive programs, the Transit Ridership Incentive Program, is intended to provide innovative incentives to increasing ridership and improving services by encouraging long-distance routes of regional significance, such as long-distance commuter bus, regional subsidy allocation models to encourage multiple transit providers in a single region to work together to sort of standardize fare collection technology. Integrated fare collection technologies is one of the other options, and reducing the impact of fares on low-income riders, such as fare reduction or fare elimination programs. Sort of one of the early casualties of the uncertainty in transportation revenues as we're moving into January is how much funding would be available to program into some of these new operations, because the language and direction that was given to the agencies of the Transportation Secretariat was to maintain a level base of funding at the fiscal year 20 level, and they have not yet developed the fiscal year 21 operating budget for any of the departments within the Transportation Secretariat. Turn to the next slide, please. Another key component of the legislation passed last year was passenger rail capacity enhancements. You established a Commonwealth Rail Fund, which consolidated Virginia's existing commuter, intercity, and freight rail programs, including the Rail Enhancement Fund, the Intercity Passenger Rail Operating and Capital Fund, and various pots of funds that were previously allocated for VRE track access and the Atlantic Gateway and Long Bridge projects. And you've put them all into a Commonwealth Rail Fund that this year should have about $96 million in annual appropriation. You also established the Virginia Passenger Rail Authority as an independent political subdivision to promote, sustain, and expand the availability of passenger and commuter rail services for the purposes of ameliorating current and future congestion, promoting industrial and economic development, and the authority, it is important to note, is expressly prohibited from operating passenger, commuter, or freight rail services. Again, this authority's mission really is to expand the access and contract for the operations. As part of this, you authorized $1 billion in 90 revenue bonds supported by I-66 inside the Beltway toll revenues. Primarily, these bond revenues would be used for construction of a new passenger rail bridge across the Potomac River and for improvements and upgrades to the Roslyn Metro Station. As you're all aware, toll revenues have been off. Commonwealth toll revenues are, at last check, were roughly off by about 50%. And I know each of the independently operated toll properties is dealing with revenue challenges. This debt has to be authorized by the CTB prior to its issuance. It has not, so it is not moving forward, but the legislative authorization for it remains valid. Turning to the next slide, please. Madam Chair, before I get into a discussion of regional transportation programs, I'd pause to see if there are any questions on the first.
Are there any questions for Jason?
Yes, Madam Chair.
Senator Saslaw and then Senator Eben.
The Metro tax, which as a result of 890 is statewide now, essentially. In the rural areas, what do they bring in per district, just an average?
Madam Chair, Senator Saslaw, what do they bring in total in each?
Revenue.
I don't have a district breakout, but I will direct you back to slide.
Yeah, I saw that one.
Right, so that's the best that I have right now is sort of our statewide total.
Right.
But that district grant fund didn't include Northern Virginia for the Metro tax, the
Right.
Hampton Roads region, or Hampton Roads.
Okay.
So, and you could do a population proxy on it. I just don't know that off the top of my head.
Was that with the one that was 100 and some million?
Yes, sir. It's 106 million in the first year, 115 in the second. And that's
Statewide,
with,
not counting Northern Virginia?
That is not
the
counting-
Richmond area or Tidewater?
Correct. Yes, sir.
Okay. There were what, about 8 groups?
I believe that there are probably, when you take out those 3, I think there are 6 districts after those 3.
So it's about 15 million.
Yes, sir.
Senator Eben.
Thank you, Madam Chair. I wanted to just make sure I got it right. On your last slide, you mentioned a new bridge across the Potomac. I think you're talking about Long Bridge. Is that right?
Madam Chair, Senator Eben, yes, that's correct.
And then there's a long-term need for another tunnel at Roslyn, and I'm assuming that we haven't yet contemplated that at all, because that's the longer-term project.
Madam Chair, Senator Eben, that is again correct. That has not been, proposed through sort of a Commonwealth Transportation Board planning process. And given the potential cost, magnitude, and scope of that project, one would think that it would be ranked with all of the other statewide projects moving forward.
Thank you.
Are there further questions? Okay, the next section, Jason.
Picking up on slide 18, within the draft proposed fiscal year 21 budget, there is more than $900 million that would be annually dedicated to regional transportation accounts to address regional mobility needs across the Commonwealth. That includes funding streams for transit in Northern Virginia, Hampton Roads, and Central Virginia. What you have done in a very logical sense is you built on the successes of 2013, which brought you funding for the Northern Virginia Transportation Authority, Northern Virginia region, and you added the Hampton Roads Transportation Accountability Commission. All of those built on regional motor fuels tax, as Senator Saslaw pointed out, the Metro tax. And you originally added sales, transient occupancy, and grantors in Northern Virginia. Last year, Hampton Roads had motor fuels and sales taxes, and you added transient occupancy and grantors taxes. In addition, there is some dedicated state recordation taxes that the legislation assigned to that pot of funds as well. In Central Virginia, much like the other two regions, you started with motor fuels taxes and sales taxes in the region dedicated. And then for the I-81 corridor, you dedicated motor fuels taxes, and for the rest of the state, you dedicated motor fuels taxes. So in a long-range perspective, Senator Saslaw was right in 2007 when we first began walking down this path. It would have been easier to raise the gas tax by a dime, and you did last year. But the benefit of the path that you took to get here is that you brought stability to your program with increased sales tax revenues, and you've really given a lot of incentives for regional collaboration on transportation projects, which I think is a bigger accomplishment than you've been given credit for. If you look at the chart on the right of slide 15, you will see the breakout there, and I won't go into it, but that essentially is the base. I would note that these have not been adjusted for any revenue impact from loss of motor fuels taxes, which I'll get to in a second, but for example, the new funding for Hampton Roads, Northern Virginia, and not Central Virginia, for Hampton Roads, Northern Virginia was slightly discounted to account for a delayed enactment that you all adopted at the reconvened session back in March. Turning to the next slide. As regional needs evolve, the regional funding programs evolve to meet those needs. In Northern Virginia, you have three main organizations, the Northern Virginia Transportation Authority, the Northern Virginia Transportation Commission, and the Potomac-Rappahannock Transportation Commission. The NVTA is responsible for planning and for highway construction type projects, as well as for distributing funding back to the localities, because that solution for Northern Virginia, that was a regional approach that worked, in which the jurisdictions got a share returned to them. Their funding streams at the authority level are based on sales tax. They're holding up pretty well. However, the Northern Virginia Transportation Commission, which is responsible for transit programs, is reliant on the gas tax, and they're not holding up as well, but it's not as bad as we thought. Down at Hampton Roads, the Hampton Roads Transportation Accountability Commission, it is benefits of both sales taxes and the gas taxes, so its revenues, while not as bad as they could have been, and they had forecast about a 13% revenue decline from their combined revenue streams. It seems like they may hold up a little bit better because of the strength of the sales tax. Out in the western corridor, the I-81 program is actually managed by VDOT, but has an oversight governing board that includes elected local leaders as well as state elected officials. And its primary mission is to prioritize $2.2 billion in identified corridor improvements and to program those projects as bond revenues are sold, which can be supported by gas tax proceeds on that corridor. So again, this solution has allowed for individualized regional approaches to larger regional problems. Moving on to the next slide, please. Any questions on regions before I get to COVID-19 impacts?
Any questions? Not hearing any, Jason.
Thank you. Picking up on slide 21, the COVID-19 impacts on state transportation revenues have been mixed. In the August 2020 reforecast assumed a reduction in transportation revenues of $870.7 million. Now, what we do know is that the actual loss for fiscal year 20 was $121 million off of the forecast. And at the time in August, it was assumed that another $750 million or so would not be collected this year. However, because of that diversification of your revenue sources, you will note, and as Charles noted, sales taxes and recordation taxes have been holding up very well. So those sales taxes, the growth in that sales tax has really kept the core programs going, and the collections through the first quarter suggest that Commonwealth Transportation Fund revenues may be about $100 million above the revised forecast. So in your December budget, well, you'll be actually making the reductions compared to your March budget. I'd forecast that you'd probably see a reduction closer to $500 million than the $750 million that was forecast back in August. I would like to say that it was prudent to initially assume a large revenue reduction given the unknown circumstances around VMT for gas and sales tax increases as people were staying home and buying less. The original $750 million impact or estimate was state only, and it didn't include any regional impacts, and we still don't really have a good handle on what the regional effect is going to be. I believe those forecasts will come out sometime along with the budget. Given the strength in sales and the general return of vehicle miles traveled and vehicle sales, some additional strengthening may occur, but it's probably going to be dependent on the course of the vaccine and the course of the virus as it goes through the economy. And flexibility in programming will remain critical to enabling the programs to move forward at their current year spending levels as we get a handle on how much additional revenue we have to program into the 6-year plan. The next slide, please. The fact that the loss may be somewhere around $500 million, it's not great news, but it's not as bad as it could be because the phased implementation of the omnibus funding bill was planned. Enactment Clause 11 of Senate Bill 890 gave wide discretion to the Commonwealth Transportation Board to ensure appropriate coverage ratios on any debt that was authorized. That's always our primary call on money. And then to maintain, all core operations at the FY20 level. Then when you were here for the special session in House Bill 5005, you provided further flexibility for the Commonwealth Transportation Board to reprogram essentially up to $1.1 billion in revenues as long as anything that was reprogrammed was paid back within the 6-year planning window and that there was a 1-month public comment period on anything that was reprogrammed. So the chart on the right shows, the approximate value of each of the buckets that you gave discretion for reprogramming. So if revenues continue to hold, you might actually be able to accomplish all of the necessary project level reprogramming within the revenue sharing program, and you might be able to see more funds being able to be put back into state of good repair, high priority projects, the district grant programs, and then to all the modes. Again, we'll have to wait until December once the CTB finalizes its budget and the governor introduces his. Next slide, please. As I mentioned, it was that revenue sharing program that provided the initial flexibility. And in its initial draft budget, to cover that, the staff of the Department of Transportation have recommended to their board an additional $200 million be programmed in the latter years of the 6-year plan to the revenue sharing program to not only pay back anything that is reprogrammed, but to make up for the opportunity cost of not having funds in that current year. And the chart on the right of that slide simply identifies the number of projects and the anticipated state match by each of the construction districts. Turning to the next slide. The real opportunity cost of COVID-19 remains unknown. The traditional 6-year planning process was delayed. A budget hasn't been adopted, and that is a completely rational way to move forward in this era of uncertainty. But I would note that if you look at the chart on the right, in March when you left, you assumed you had $261.1 million to put into this is all new money going into new buckets. So the easiest one I think for consideration is the one called ridership incentives that I had mentioned earlier. And so in March, you anticipated that you'd have $11 million in the biennium to program for that new program. The current draft budget only anticipates roughly $3.6 million. Same thing with the special structures program. You thought you would have 40, and you might have 5. And again, it's not a great story, but it's not as bad as it could have been or could potentially get. And at this point, you haven't really cut any actual projects. The opportunity cost with respect to new construction is illustrated on the chart on the left. Back when the bill passed, it was assumed that for the Smart Scale Round 4, so that would be a 6-year round, projects over a 6-year period in a round, that you would have about $2 billion in new projects that you could move forward. Until the dust settles, that will be the last piece of the puzzle that you solve for, and you won't know exactly how much new money on construction projects you will have to advance. Moving to the next slide, please. The pandemic has also increased transit expenses while decreasing revenues. Programming of the fiscal year 2021 state transit capital grants is focused on sustaining the operating grants at the fiscal year 20 level with a very limited program for new capital acquisition. The total funding level of $101.6 million in fiscal year 21 is a slight increase over the prior year, and the 5-year transit capital budget was not updated due to uncertainty of post-pandemic capital needs, and it's expected that transit capital plan will begin to be developed again beginning in fiscal 22. The Commonwealth Transportation Board is anticipated to prioritize meeting the long-term annual commitment of $154.5 million to WMATA for its capital program, and the recommended budget does cover the estimated shortfall in dedicated WMATA capital of about $17.6 million using unobligated transit capital funds from fiscal year 21. COVID impact on toll revenues from short-term market impacts have also had a ripple effect to other modes. For example, in Northern Virginia, the Northern Virginia Transportation Commission reports that I-66 Round 4 revenues, which support commuter choice program, was reduced from $25 million over 2 years to $4 million over 1. So again, as the economy continues to rebound and traffic continues to pick up, these things will begin to, new funding will become available for these programs as those things take place. Next slide. The CARES Act did provide short-term transit relief. Virginia was allocated $456.3 million in federal transit infrastructure grant funding through the CARES Act. Most of that went directly to large urban transit agencies. However, $52.5 million went to rural transit agencies, and another $47.2 went to small urban transit agencies. This is approximately 3 times the amount of federal transit funding appropriated to Virginia transit agencies in fiscal year 20. So the federal response in transit initially was phenomenal, and it didn't require any state or local match, and it enabled services to continue and for appropriate PPE measures and protection to be put in place. I would also note that WMATA received its own separate allocation of $876.8 million from a direct CARES allocation. However, as you all know, next slide please, those funds have to be obligated by December and expended within the first quarter of next calendar year. And that is not looking like what recovery for transit programs is going to be looking like. Recovery is much slower than anticipated when services were initially reduced in the spring. Fare revenues are likely to remain substantially below budget The CARES Act funding will be depleted with no federal relief on the immediate horizon, and transit operators will likely face operating shortfalls until well after the vaccine. And WMATA faces significant challenges. Many of you may have read that its daily operating loss was somewhere in the neighborhood of $2 million a day. Therefore, the draft fiscal year 21 plan for transit recommended maintaining the $50 million match for PREA, $173.6 million for WMATA operating and capital, which is an increase of 14.6, and that $154.5 million in dedicated capital funding, also for WMATA for that regional capital program match. Next slide. As we turn to the 2021 session, the phased implementation of legislative changes adopted in the 2020 session are well underway. State and regional funding programs did lose revenue from COVID-19, but the cost was largely new opportunities. Transportation-related revenue sources appear to be improving as sales remain stable and travel is beginning to return. State programs benefited from fuels tax increases as consumption declined, but local authorities that are dependent on sales tax or on fuels tax revenues did not, because their rate was not increased. Additional travel restrictions could negatively impact transportation revenues in the future. COVID-19 will continue to place new operating costs on transit systems while ridership is down when additional federal support, and it's uncertain when additional federal support will be available. This may put pressure on you in the 21 session to provide additional funding to support transit operations statewide. At this point, it's unknown what that request would be, or if Congress will sort of come in with another CARES Act with a specific focus on transit and transit providers. And finally, really, limiting legislative changes during the 21 session would ensure stability in the implementation of the changes adopted last year. At its meeting on Monday, JLARC advanced a study recommendation, a study proposal to have the JLARC staff review the state's highway and transportation infrastructure, review funding sources used by transportation industries, trends in VMT and changes in commuting pattern, challenges facing transportation facilities, particularly the port, I-81, I-95, and the impact of non-combustion engines and more fuel-efficient engines on transportation revenues. It seems to me this year would be a good year to pause briefly, to see how the implementation goes, to see where the revenue shakes out, and to see what JLARC recommends for the 2022 session. Madam Chair, that completes my remarks.
Thank you, Jason. Are there any questions for Jason? Okay, not hearing any. Thank you. And April, you have some announcements for us.
Thank you, Madam Chair. Just a few quick announcements. In your notebook, under tab 7, there is some important dates related to the budget amendment process, which I'll cover in a second, but there is also in the little folder travel voucher. If you are able to go ahead and fill that out, you can leave it either with Melissa, who's sitting in the back, or bring it up to one of us here in front, and we'll take care of getting that turned in for you. Just a reminder that the Joint Money Committee meeting date on the introduced budget is December 16th. We'll obviously follow up with an email. Public hearings are going to be the week of January 4th. They're going to be all virtual. The plans currently tentatively are to have 4 regional public hearings. We're still trying to figure out if we can do all 4 in the same day. Potentially January 6th. Again, we'll follow up with information on that. Also, we're looking at doing a Senate Finance and Appropriations Committee meeting prior to the start of the session on January 13th. We're looking at January 11th or 12th. Melissa will be polling for that. And I did just want to mention, because we compressed this meeting into 1 day versus 2, that both Adam and Caitlin will be doing presentations in during that time in January. Caitlin will give some updates related to public safety. Adam is arranging a panel with related to local government impacts around the pandemic and use of the coronavirus relief funds. Either that'll happen at the full committee or on the joint subcommittee for local fiscal stress. And we'll also likely hear from an economist at the Fed on Virginia-specific impacts that are ongoing. Economic impacts. Turning just quickly to the budget amendment timeline, as I mentioned, January 13th is the start of the session. The chair has stuck with the normal deadline for budget amendments. for that first Friday, which is Friday, January 15th. Those budget amendments will need to be in by 5 p.m. Here's where the difference is. The budget amendments are going to be able to be submitted electronically this year through the e-file system. That's going to be brand new. It hasn't been set up yet. Again, the budget will governor's introduced budget will come out in mid-December. Training will be scheduled on that if you're interested for your staff or yourselves as well. And the other important dates related to that are under that tab 7, so I won't go on about that. And lastly, I just wanted to not just thank the committee staff for working so hard to put this together, but also Madam Clerk's staff who's helped us get this set up here at the Science Museum. They have been fantastic and we appreciate all their support. So that's it, Madam Chair. Thank you.
Thank you, April. This really has been quite a year for the Senate Finance Committee, the whole Senate, and most particularly our staff. We went from a long session, which was very intense on the budget, to having to virtually undo everything that we had done during the veto session, then coming back for the endless special session, where we went in depth again into the budget. And now just days later, you've put together this retreat. We have high expectations of this staff and you always meet them. And I want to thank you, and I think we should give you a standing ovation. And now we're adjourned.